Hello and welcome to this conference on fintech and COVID-19. My name is John Byrne. I'm a research fellow here in Tokyo at the Asian Development Bank Institute. This conference is jointly organized by the Asian Development Bank Institute, the Asian Development Bank, and the Cambridge Center for Alternative Finance. So over the next 3 days, we have a quite full program. Just briefly on the house rules, should participants wish to ask a question, I would encourage you to use either the chat box or the Q&A box. Alternatively, you can raise your hand, and if time permits, we will allow you to speak in a more live format. So without further ado, in the interest of time, I would now turn to Dean Tetsushi Sonobe of the ADBI to give some opening remarks. Please go ahead, Dean Sonobe.
Okay, thank you, John. Thank you. Hello, everyone. On behalf of ADB Institute, I'd like to provide some opening remarks for this conference on fintech and COVID-19. It's a great pleasure and honor to host this conference jointly with our partners, the Cambridge Center of Alternative Finance in the UK and the Asian Development Bank in Manila. We thank Mr. Brian Zhang, co-founder and executive director of Cambridge Center, for providing opening remarks. Mr. Herman Smith, Associate Director of Data and Analytics, Cambridge Center, for serving as chair for the first keynote speech session, and James Villafart, Senior Economist at ERCD of ADB, for serving as the chair of session 1 and today's second keynote speech session as well. We also thank the two distinguished speakers, Professor Jin Chuan Duan, the Jardine Cycle and Carriage Professor of Finance and Executive Director of Asian Institute of Digital Finance, National University of Singapore, and Professor Pinar Ozkan, Professor of Entrepreneurship and Innovation, the University of Oxford, for their keynote speeches. The topic of this conference is timely and relevant to the challenges the world has been facing for the over last 1 year. While the availability of alternative forms of finance has been growing steadily over the past decade or so, COVID-19 shock is said to have accelerated its growth, particularly the pace of digitalization in finance, suggesting that digital transformation in finance is a structural change taking place simultaneously across the world. The COVID-19 shock is also said to have exerted disproportionately negative economic effects on micro, small, and medium-sized enterprises, or MSMEs, and poor households. An intriguing and potentially important hypothesis is that innovators and users of fintech have helped to mitigate these negative effects of COVID-19 shock on relatively vulnerable firms and households. Empirically, however, we have to say that relatively little is known about the impact of COVID-19 on business models, structures, and practices of fintech firms. Empirical knowledge is also limited about the use of fintech among MSMEs and among households. We must also bear in mind that the rapid acceleration of fintech can also pose risks to financial stability, with implications for financial regulation. And these risks have perhaps been amplified in the current environment. Against this context, a background, we are having this conference over the next 3 days. We hope to gain a deeper insight into the important role of fintech during the pandemic in providing respite to the vulnerable groups, issues related to enhanced digital financial inclusion, and balanced and sustainable economic growth. We also aim to understand more about the factors underpinning the growth and the resilience of fintech providers during the pandemic, as well as the financial stability implications. We are pleased to have an excellent set of distinguished keynote speakers on each day of the conference from the perspectives of both academia and international institutions, as well as fintech providers from the private sector. The topics that we will cover are comprehensive across the implications for the macroeconomy and the wider financial system, with important aspects relating to financial inclusion and regulation featuring prominently. We are also looking forward to learning a lot through our discussions on the important roles of fintech during the pandemic, as well as its potentially long-lasting effect in the post-COVID-19 era. I hope that we will also deepen our understanding of the policy challenges that we face ahead in this context. With that, I conclude my welcome and opening remarks. Thank you very much for your attention. John, back to you.
Thank you very much for these opening remarks. Now we will also have some brief opening remarks by Brian Zhang, who's the co-founder and executive director at the Cambridge Center for Alternative Finance. Brian, please go ahead.
Thank you very much, John. Good afternoon and good morning to everyone. Many thanks for joining us today. It is our great pleasure to welcome you to this event and to co-organize this virtual conference on fintech and COVID-19 together with the ADBI and the ADB. At the Cambridge Center for Alternative Finance, our mission is to create and transfer knowledge, addressing emerging gaps in the financial sector that supports evidence-based decision-making. Fintech and other forms of digital financial services have long been regarded as holding enormous potential to widen and improve the access to finance for millions of unbanked and underbanked populations, especially in emerging markets and developing countries. Over the last few years, it has been our honor and indeed a privilege to work alongside with our colleagues at the ADBI to conduct empirical research and generate essential knowledge to deepen our understanding of the burgeoning fintech markets across the Asia-Pacific region and inform the decision-making of key stakeholder groups. Together, ADBI and the Cambridge Center for Alternative Finance co-published the third Asia-Pacific region online alternative finance report back in 2018, the first ASEAN fintech ecosystem benchmarking report in 2019. It was also thanks to the ADBI's foundational support and incredible hard work of its capacity building and education team. Our Cambridge FinTech and Regulatory Innovation online program has trained more than 900 central bankers and fintech regulators from over 200 regulatory authorities and from 120 jurisdictions worldwide, with 265 regulators participated and graduated from that program from across the Asia-Pacific region in just over the last 15 months. If fintech knowledge creation is important under the normal circumstances during a global pandemic, when the financial services industry is accelerating its pace of digital transformation to provide critical support to life and livelihood, it becomes a development imperative. Indeed, COVID-19 highlights the urgency to understand what is happening on the ground, where digital means could be the only viable option for many people to make or receive a payment, access savings, get insurance, or raise capital. And policy and regulatory decisions about fintech can have an immense short-term and long-term impact on economic recovery, SME financing, gender empowerment, infrastructure development, sustainability, and financial inclusion. And that's why through the UK Foreign Commonwealth and Development Office funded Cambridge Alternative Finance Collaboration Network Program, a cross-regional and cross-sectoral knowledge network that aims to accelerate the production and dissemination of fintech knowledge we're deepening our collaboration with ADBI to collect more empirical data in fintech, create scalable and accessible digital tools, and expand our efforts in capacity building and education. And this important conference today is a manifestation of that deepening partnerships with the ADBI and our colleagues at the ADB to facilitate a more and much needed fintech knowledge creation and transfer. I want to take this opportunity to thank the leadership, foresight, and continued support from Dean Tatsushi Sonobe, Vice Chair Peter Morgan, who has been instrumental in forging that partnership, and John Yuko, and many colleagues for organizing and curating this virtual conference. I look forward to hearing presentations and engaged discussions over the next 3 days, and I wish this conference a great success. Thank you. I will pass the virtual mic back to John.
Thank you very much, Brian, for these insights. Let's move swiftly on to our first session, which is the keynote speaker. The session will be chaired by Herman Schmidt from the Cambridge Centre for Alternative Finance. He's an Associate Director of Data Analytics there, so I will leave to Herman to introduce the speaker. Please go ahead, Herman. Over to you.
Many thanks, John. I'm very excited today for the session of Professor Duan from the Asian Institute for Development Finance at the National University of Singapore, who will be talking to us about credit data solutions for SME financing, and particularly through a new initiative and partnership forged between the university and local fintech. Professor, over to you.
Okay, thank you very much. Thanks, Dean Sonobe and Director Brian Huang. Sorry, I got it screwed up. Anyway, thank you very much for organizing this event, and it's my honor to share with the research work I've been working on, and it is quite a substantial undertaking. So I'm going to try to skip those very technical sides of these things. Okay, instead I will focus on the conceptual elements of the whole idea. Okay, so I'm going to charge ahead, and so please do remind me, Herman, if I have 5 minutes left, so I can wrap it up. So I have time for questions.
Certainly will do. For the attendees, if you would like to pose questions to Professor Duan, please drop it in the question and answer session. We will then take the opportunity following the presentation to address those questions. Thank you.
Okay, so the title of my talk is Sharing Credit Data While Respecting Privacy. And that respecting privacy is a key. And it's a digital solution I've been working on for several years now. Finally, but last year or so, in the beginning, I really come up with the idea to solve it. I assembled a team and to work on this. Now we have an actual operating system already, and we are in the process of organizing to create a consortium. Anyway, I'll share with you detail later on. So just that's basic background. And the Asian Institute of Digital Finance is a new organization. It's a university level institute at the National University of Singapore, and it's supported by MAS, which is a Monetary Authority of Singapore, and the National Research Foundation of Singapore. Okay, I'm also in addition to be a professor, I'm also a practitioner. I co-founded a fintech company, so I suppose I can claim I'm a practitioner as well. So here we go, and I'm going to charge ahead. So think about the pain point. Everybody's talking about insufficient financial inclusion. Indeed, that's a case. And today I'll be talking primarily about MSMEs, micro, small, and medium-sized enterprises. And the financial challenges you can sort of find in everywhere, almost in the literature now, and because of SME or MSMEs are facing difficulty. Right, but because it's an ADBI conference, I think it's very fitting to come up with a quote directly from an ADB report, and it says that SMEs are mostly affected as they tend to have a higher rejection rate. Okay, and because of lenders, right, and lenders are more reluctant to lend to them. And primarily, I want to emphasize these the things highlighted in red. because they have a higher transaction cost and information cost. Okay, so that is actually the key I will be talking about. So I'm not talking about generically have a financing challenges, and I'm more talking about the source of challenge. Okay, I think that's the key, which perhaps you hear a lot of solution about to help out MSMEs, but you may not have heard any things in this particular line of thinking. Okay, the COVID-19, of course, is a theme of this conference, and this pandemic has definitely worsened the situation for MSMEs, but I don't suppose those are structural. And something as structural was remain even when we recover completely. So today, what I'm talking about is actually something very structural. So I don't think it has much to do with COVID. COVID just exacerbated a lot of problems, but when COVID goes away, we're still going to have those problems. So we better to address them. And the solution rests with digital technology. Okay, so pre-COVID pandemic, I'm just going to give you an example because the government assistance program is, it's widely available. You go every country and you will find some sort of assistance program. In ASEAN, it's no exception. Many governments have some program in place. Let me take a Singapore's program to offer you the sort of kind of style and kind of financial assistance available. Singapore, prior to COVID pandemic, actually already offered, among many things, of a 50% loss share with FIs, with financial institutions on SME working capital loans. There are many categories of loans. I'm just using SME working capital loan as an example, 50%. That means that when the borrower default, when the loss incurred, government will pay 50% of it, co-share with FI. That's very generous, right? Think about it. And in COVID pandemic period, the loss share ratio has gone up to 90%, but we still hear and people still complaining they don't get financing. So what it's telling us is, even 10% loss, 90% absorbed by government, is still a loss. Financial institutions are reluctant to engage in something, lend to the customer they are not familiar with. Okay, so post-COVID, COVID is important, but post-COVID, I will use this as a movie term, but change it slightly, back to the past. So we're going to back to past because those survived the SMEs are still going to have a problem, right? Because it's a fundamental informational gap we are facing between lenders and MSMEs. Okay, that I'm going to elaborate. So I'm sure you will agree with me. So this small organization, the businesses, they are in a sort of pooling equilibrium. Economists will call it pooling equilibrium because we have a hard time of separating good ones from poor ones. And I think all of you will agree with me. There are plenty of funds available these days. So I personally get a lot of phone calls on lending money because the liquidity is so abundant. So why MSME still have a financing difficulty? It's because it doesn't make any sense for lender to engage in information acquisition on small loans. It's too costly to do it. Why do they want to do it? So therefore, we have a chicken and egg problem. Because if a lending institution has not engaged a lot of MSME lendings, they will have no enough experience to discern or to create a good model. And if they don't do it, how are they supposed to have the data sufficient to do that? So that's the point I'm trying to address, really. Okay, so before I go any further, I would like to emphasize one point. This point is actually very critical, is that not all MSMEs deserve financing. Because you probably know, in your circle of friends, you encounter something, you don't think it's actually a viable business idea, but someone want to give a try anyway. So I don't think provide assistance to those companies or MSMEs, it's actually a wise thing to do because something are not fundamentally viable. Why should it be provided financing? In fact, it will cause the person to lose more money. Personal saving and all that will be lost in the process. So I think the better, smarter strategy and smarter financing as assistance is to create a separating equilibrium. Let financial institutions directly to lend because they don't need to be urged anymore because they can actually separate good ones from poor ones. Therefore, I think the government's role or public sector's role should be in building a financial infrastructure as opposed to provide direct assistance. Okay, that's the central idea of this. And this infrastructure, I call it common good. I highlighted, and with a boldface too, common good. It's not a public good because this is almost like a club. Had to be sort of among lending institutions. Okay, that's what I call a common good. So they can engage in smarter lending practices. Okay, so the idea of the way to achieve this is to share data for smarter credit analytics. So we're going to have a purpose-guided credit analytics. Okay, it's not like just have a credit analytics. What we want is some very clear purpose in mind. So let's think about it. What kind of data we have? Borrower's attribute. Okay, they could be in a conventional form, like a financial statement and all of that. Okay, bank's transaction records. But they can also be in an alternative data form. And this is a sort of, it's almost cliche now. A lot of people talk about alternative data, primarily because we leave so many digital footprints. And also we have a means to digitize old documents too. So in other words, we are actually in a position to come up with very good analytics, right? But that's true and also not true. Because the data, later I will use notation to sort of make it very concrete. Basically, data are two types. One is attribute. The other one is a label, is an outcome. Only lender actually has lending experience, knowing with particular borrower with particular attributes, whether the person will pay back or not. That Y variable, I later will call it, is actually very critical. That is actually solely missing, and we really need to have a lender to take part in this undertaking. Otherwise, you can have as many X variable attributes will not help the credit models. Okay, so sort of key. So the purpose-built credit analytics had to take into account the modern reality, and also we had to recognize a very important part of lending organization. So in order to pull data together somehow, we also had to respect data privacy. And that is very real, it's legal as well as out of respect for customers, right? So data privacy is something we have to somehow manage to preserve. And so how can we pull data together then? The hope is rests with the digital technology, right? Because with digital technology, previously impossible things may become possible. What I'm going to do is to convince you it is possible, it's doable, it's not concept, it's a reality already. So the big data reality anxiety, I also want to mention this before we charge further ahead. That is, big data is great to have in concept, but in reality associated with big data is a big missing data problems. So we must have analytics to address missing data problem too. Otherwise, you create one additional field of alternative data, then you create even bigger problem because the conventional data cannot even be used because this alternative data is not complete. Okay, some obligor or some borrowers has entry under this alternative data entry, but others do not have. So this is just a reality one should have to keep in mind. So, okay, suppose the technology, which I will show you later, is available. So what we're going to do as a business model, here I'm arguing, we're going to have a co-opetition model. Basically, we're going to pull credit data together while respecting private data privacy. And this data rests with multiple lenders, and it can be banks, finance company, P2P platforms. So we're going to use that data to create a credit model or a suite of credit models, okay? And we're going to treat the models as a common goods among participating parties. So this is not public good, this is a common good among participating parties, okay? So the things we need to overcome is data privacy. Okay, so we can then develop a digital technology, and if we data that kind of data with a privacy consideration available, suppose we can develop a digital technology, allow us to calibrate the model over the distributed data side, then we achieved our purpose. Okay, so that's what is going on. So the co-opetition model, business model side of this is the participating institution actually get to share the model, and yet they are going to add their own twist in some way and to compete. Okay, so that's its core application model I'm referring to. Okay, so they rely on common good plus their own tweakings here and there, and maybe market niche, maybe the risk appetite to compete. So it's still a competition in the end, but it's more like infrastructure made available to unleash better productivity. That's roughly the idea. So this data, credit data, we can actually view them as an incomplete data panel, which is incomplete is very important because you don't expect every data field and the data is complete for every article. Just not reality. I have been dealing with the credit data for so long now, just impossible, right? Whenever you deal with the credit data, there will be a lot of missing data. Okay, so here I'm going to use a little bit of notation to make a concept very concrete. Why? Because we're talking about credit. So this sometimes we call them label, but it's really dependent variable. It's a categorical variable, which take on the value of 0 means a survival, 1 say default. These are just a bit arbitrary, right? 0, 1, 2, you can name anything you want. But 0 here, it means a survival. 1 is default. The other one is the other corporate exit. In this particular context, is discontinuing a banking relationship. And these are actually very important because if a borrower discontinue lending relationship with you, does not mean the borrower defaults, right? But that has to be factored into your credit portfolio decision making and the portfolio analysis. So we, at the minimum, have to have a 3 category. Then we can potentially have a huge high dimension of X variable, like leverage, like whatever, utility consumption, like many things, right? So X dimension can be potentially very high. So that's a big data. Then we can also have many data instances if we start pull different sites together. So the number of data instances can also go very high. So there are these 2 dimensions of big data potentially happening here. Okay, so that's the setup. So a credit model, in particular, probability of default model, is a model which is linking Y to X. In other words, we're going to use X to predict Y, right? It's a supervised learning in that sense, right? So I'm using modern machine learning language. It's a supervised learning. So let me just use a bit of notation to make things very concrete. And all this complication is actual necessity, although it's not a heart of analysis. I want to sort of let you know these are the complications one had to consider. And if you sort of listen to my talk today, go back to reflect on a lot of credit analysis out there, they actually don't even consider this dimension. Basically, we're going to have a borrower, let's call it I, and at some time point T, thinking about future. This future is very complicated. It could be next 2 weeks, could be next 1 month, could be next 1 year. Okay, so there are garden variety of relationship. Lending can also occur at some future point in time. Now we call forward lending, right? So you really have to think about all this forward period. It's this methodology I developed years ago called forward intensity model. The basic idea now is we want to describe the outcome related to attribute today, the future outcome in the future period, which we of course do not know now. There's a probability of occurrence of that. And in particular, 2 occurrences are very critical. One is default, the other one is other kind of corporate exit. And why the survival is not important? It is important, but there's no need to model because 3 events had to add together to be 100%, right? So the other one is just a complement of this. So anyway, a model is basically we choose F or G functional form that define a model. Theta and this another the parameter. These are so-called model parameter. They help us to fix the model, right? The type of model determined by functional form. Parameter to fix the model. So that's why we want to come up with, right? As a modeler. So analytics I'm talking about is a general analytics. Doesn't have to be a particular F. Okay, but almost every model you can think of, it falls into something like this. In addition, I consider the variety of future periods, so which is a must. Anyway, yeah, go ahead.
We have about 2 or so minutes left, so just.
Oh, really? I thought I have a 30 minutes.
So we can definitely go over by a couple of minutes into the question and answer session. So
okay. I thought I have it's only 20 minutes. Okay, I thought I have 10 minutes. Anyway, okay. So anyway, let me go on. Okay, so what we're going to do is something called federated learning. So we're going to pull data from multiple sites together. The point I want to emphasize is you can think about it, each individual borrower for particular lending institution, if we denote by I, we're going to aggregate them to some number. So by looking at outcome of F function, you cannot even go back to the original X. Need to say, we don't even need that number. We need them to aggregate into another number because one lending site has so many borrowers. So they will aggregate into something I call L sub M, M to denote that particular lending institution. Okay, so the lending institution only to transmit this number back to the calibration central. Okay, that's always needed. So then we'll come up with a new parameter and send to the lending institution and back and forth. This is how we optimize. This is the idea of federated learning. But that idea is easy, conceptually speaking. And so here is that concept. You have a number of sites here, central interact with that. Okay, but the problem is whenever you deal with multiple sites, you have to realize there's going to be transmission problem. So there's always going to be network latency. There's going to be site failures. So your optimization cannot continue unless we can overcome this. It turns out we are actually able to overcome that with some soft computing techniques. Okay, so essentially it's approximation. So the result literally will be the same as the true result of the whole similar whole data. Okay, some failure is okay. It's not going to cause a problem. So anyway, so that's what a federated model calibration. We're going to maximize something like that. That's a composition of multiple sites. Okay, so these are robust to network latency and the individual site failure. Okay, so here is actual software has been developed, has actually in operation, have been tested, and will be using for the consortium. Okay, that's what I'm going to say. And alternative data can be accommodated, since I don't have time to go to the detail. And alternative data is likely to be site specific, so we're going to accommodate individuality as well. So that has been done already. So the idea here is going to set up something called a consortium. We call the ASEAN MSME Credit Analytics Consortium. So we're going to persuade banks, P2P platform. We already have 3 parties agreed to join, and we actually do a test run on that already. And so we're going to create something called Model Calibration Central, and then support something called User Support Central, because a calibrated model is going to be supported and by the institute as well. So user, which is going to be a financial institution, is going to make a query, almost like a credit bureau kind of query. They were saying customer information and will compute for it using the model, because instead of that, for them to set up infrastructure for that, it just doesn't make much sense. So we're going to do a centralized this. And so, that's how it's going to be happening. Hopefully, I can get more parties to agree to join. And so the operating principle, I think I just take a minute to share. We're going to set up something called a governing board, which will be founding member of the consortium, and it will set many, many policies. And we're going to have a member committed to a third-party audit, so make sure that the data they submit are actually up to standard. It's not they don't make up numbers. Okay. And so we also have to address free ridership. Where some party just say, well, that's only data we have, and the other party just been a free rider on it. That doesn't seem to make sense. So we're going to address that by tier membership and so on and so forth. So there are many issues, operational issues have to be addressed. So let me recap, okay? So then I'll take questions. The financial assistance to MSMEs through loss sharing, I just don't think that is a very effective way of doing it. It helps, but it's not does not effectively address fundamental informational asymmetry. Okay, so I think we need to help lenders to lower their information acquisition cost. Okay, once we do that, will be very helpful, I think. Okay, and the model is going to be co-opetition model among lending institutions. And this methodology actually can go beyond credit, right? It is low cost, it is universally applicable in many settings, I believe. So let me just stop here.
Thank you so much, Professor. That is very exciting initiative which you're starting, and I think definitely very useful solution currently to the challenge of providing credit to SMMEs. I think firstly, there's a lot of interest in the slides. So we have several comments that the slides will be available subsequently. So just to indicate a large amount of interest there. I've had the privilege of seeing the slides before the session, and I was very intrigued by various components of the proposed digital platform that you're building, and also the governance structure and the data sharing structure of that platform. So I think I'll start off just with one or two questions while the panelists get ready to, or the attendees provide questions as part of the Q&A box. So maybe the first question is just to see how this is different to existing credit sharing information systems. So globally, particularly on the consumer front, the precedence of financial institutions sharing credit-related and client-related data in a common pool for credit scoring purposes. This is a phenomena which many incumbents do on the consumer side. Can you maybe point out just some of the key characteristics that make this different to the incumbent credit sharing information systems?
You know, if you can manage to persuade parties to share data or by mandate, the government mandate, it's definitely technologically more superior in that way. Because the distribution here, distributed data side, is not technologically superior. They create a lot of problems, but it's more like a privacy necessity, privacy-driven necessity. And I've been trying to persuade lending institutions to share. And the excuse or reason they resist to it has always been privacy. Okay, it is in response to that. I do know there are some countries, they actually force financial institutions to surrender data to some sort of bureau. Okay, and the bureaus has almost like a monopoly power. If they utilize information properly, they probably can build a very good model. Okay, but then you can also see this problem with alternative data that's very limited, because when you want to centralize a force party to submit by legislation, and you have to be sort of simple in many ways. Okay, so they cannot accommodate individuality, I think. Okay, so I'll be the first to admit, if you can get people to agree to put data together, that is much more efficient way of doing it. Okay, decentralization here is not by desire, it's by necessity. Okay.
Thank you, thank you. And continuing along, particularly what you spoke about, the difference between existing credit sharing information systems, and typically that falls within a government mandate for sharing of data. Your model will be voluntary. This co-opetition model that you're suggesting, I'm assuming that this will require starting with a smaller number of institutions and a smaller number of data sets or sources that you will use as the base case. Can you take us through what goes as part of that selection criteria of the early institutions and the type of data that you accompany on the digital platform?
Okay, and the institute is in a very privileged position because we do have a data. Because most participants probably do not know, we have the institute, the Credit Research Initiative, has been in operation for 12 years now, over 12 years. We have a world's largest corporate default prediction system, operate on exchange traded companies around the world. And there are some exchange traded companies are classified as SMEs, because even the SME by definition, it differs from jurisdiction to jurisdiction. Okay, but anyway, there are some SMEs really considered SMEs, so that we already have a data to complement the data of other people have. So you are right, we have to start from small, because so far I already managed to convince 3 parties to join. Okay, and many people are not saying no. Many, when I say not people, they are organizations. They are they're watching the development. Okay, we know a lot of things are chicken and egg issues, right? So, and once you build up to the point, people would like to join, right? because but so yeah, it's going to be start small. And I think what makes this particular platform is very attractive is we can actually accommodate alternative data too. So in other words, it can be sort of model almost unique to one particular lender, partially unique. Okay, so I hope, I'm still hoping it will be a lot of excitement, people will join, but I personally have run into quite a number of reluctance actually. They actually raise a lot of issues. Why do I want to contribute my data? Because my competitor will benefit from it. I always say that's short-sighted, right? Because you benefit from it too. But anyway, those are practical issues beyond technology actually.
No, and I think if you resolve that cooperation challenge and competition model as you position it, I think there's a lot of benefit that can be derived from that in terms of information sharing. I think the last question from me, there are a number of individuals who are interested in getting your email address in the slide, so I'll let John and Yoko maybe follow up with them on how that would be possible. But I think the last question from me is that firms in this credit sharing model, you talk about the fact that firms have their own data and then there's data that they can leverage off the system. How do you think firms will have to balance that for their own reporting requirement and risk assessment requirements? So as we know, from de-risking perspective, having capital in specific industries or sectors should be rated at higher risks and require different types of reserving. Will this model assist firms in that, or will this potentially create a blind spot for them in their risk assessment?
So I think the initial usage of the model is not going to be for compliance reasons. It's for pure business case. So it's an internal decision making, right? Compliance, you have to sort of meet the regulatory requirement. Typically, they are not very high standard because the standard model, some sort of simplified assumption. So I envision, I purposely classify into conventional data. Why conventional? Because most people sort of in business, they all agree these are like leverage and stuff like that. So they are very much sort of accounting-based standardization already. Then we can talk about alternate data, sentiments, for instance. No two parties will agree exactly how sentiments should be defined. So therefore, there will be a lot of individuality there, right? So I don't think, going for one type of data, you had to somehow abandon the other type of data. That would be silly, right? So that's why I would say this, the complementarity is very important. Share on the conventional data because they are conventionally defined. So there are very little disagreement on those. So whenever you do things, you had to be sort of across multiple sides, multiple parties. People had to agree on definitions, right? So that's what I'm talking about, okay? Then there will be alternative data. Every site has their own definition, their way of doing it. So it's a combination, the mixed model.
Many thanks. We've run out of time, but it was fascinating, and we wish you the best of luck as you continue with this endeavor. And we look forward to seeing how this evolves and how you're able to create a state of competition in Singapore and in the other markets in ASEAN that you work in.
Okay, thank you, Herman, and thank you for listening. I hope you have some takeaway. Thank you.
Thank you very much. Before we move to the session one, I also had a quick question, which maybe we could answer bilaterally if given the time. But Professor, you talked about the fact that it's more of a structural change that we're seeing at the moment as regards the credit system that you're talking about. But I wonder, is there any impact that COVID had, even in terms of accelerating the process?
The COVID's impact is that people are more receptive. Because a lot of people have been forced into, previously they're reluctant, like we academics are reluctant to conduct online lectures, right? And we are forced by COVID. So I think that COVID is sort of like a catalyst.
Okay.
But the issue I was addressing is there. Before COVID, it's going to be after COVID.
Yes.
Right? Because that informational pooling equilibrium, it's just a problem all along. And all these government assistance programs never address the pooling equilibrium problem. They just keep on saying, I absorb the loss along with you. I don't know the borrower, you don't know the borrower, we still just don't know the borrower in the end, right? Except reduce my loss so I lend. I don't think that's a very good way of doing it.
Okay, no, very interesting speech. Thank you very much. We've gone a little bit over time, but we'll make it up in the break anyway. Moving swiftly on to session one. This is the first of three papers that will be presented today. James Villafuerte from the Asian Development Bank will be the chair of this session. So I will hand over to James. Please go ahead, James.
Thank you, John. Good afternoon, everyone. Good morning, everyone. So we are now in session one entitled COVID-19 Financial Technology, Macroeconomy, and the Regulation. We have three papers. For each of the paper, we have a discussant. So for each of the paper in the discussion, we've allotted 40 minutes. So 20 minutes for the paper presentation, 10 minutes for the discussant, and then 10 minutes for open forum. To manage the time, you'll hear a bell. I'll ring the bell 3 minutes before time is up, and then 2 bells 1 minute after the time is up. So for the first paper, let me call on Eric Alexander Sugandi, who is a project consultant at the ADBI, to deliver the paper on COVID-19 and the Indonesia fintech market. Eric, the floor is yours.
All right, thank you, James. Okay, so I'll share my presentation slide first. Sorry, it takes them. Can you see the slide? Not yet.
It's not yet visible, Eric.
Yes.
We can see your root directory. So
all right, I'm opening the slides now.
We are seeing your Microsoft Explorer.
All right, now can you see it? Not yet.
Not yet.
All right, sorry.
Sorry, Eric, we will share your slides directly from here, and you can just say next, okay?
All right, okay.
Okay, so we'll start now.
All right, so
Okay.
Good evening, good afternoon, everyone. Today I'm going to present my paper on the COVID-19 pandemic and Indonesia's fintech market. Next slide, please. All right, okay, so this is the organization of my presentation. We go directly to the first section, introduction. Next slide, please. Right. Indonesia is a big potential market for the fintech industry, and then based on the OJK or the Financial Service Authority or the OJK classification, there are 4 types of fintech products in Indonesia. Based on their respective business model. First is the digital payment. Second is the online payment. Third is the digital financial innovation products, such as the blockchain, market aggregation, and other types of products. And then the last one is the equity crowdfunding. Now, there are 2 authorities that are responsible for regulating fintech industry in Indonesia. First one is Bank Indonesia, that regulates fintech products that are related to the payment transaction, and the second one is the Financial Service Authority or the Otoritas Jasa Keuangan or the OJK for other types of fintech services. Now, the COVID pandemic has hit the Indonesia's economy, but it seems that the fintech industry have survived the pandemic. And then even some analysts claim that the pandemic and then the large-scale social distancing or the PSBB policy has helped to accelerate fintech market development in Indonesia. This is something that we're going to test in the in my paper. And then the paper examines the impact of the COVID-19 pandemic and the PSBB on Indonesia's fintech market. It also discusses the roles that the fintech companies can play in Indonesia's economic recovery. Next slide, please. All right. Now, we discussed about the related literatures. Many literatures show that the COVID pandemic, the lockdown policy or the social distancing policy have promoted the use of fintech technology on a worldwide scale. For example, we can see the study by the University of Cambridge Just Business School, CCIF, and the World Bank, and also the study by Fu and Mishra. That said, the impact of the pandemic, the lockdown, or the social distancing policy on the fintech are different across countries and across markets. Some studies suggest that the pandemic harmed the fintech market in particular countries, but others show that the pandemic helped to promote the fintech market in other countries. Now, some studies and reports also show that many authorities in many countries are in fact already utilize the fintech companies to mitigate the negative impact on the COVID-19 and to help to restore their economy. These studies by Errol and Lieberson, as well as Davidovich et al. Show this. Next slide, please. Next, we discuss about Indonesia's fintech market dynamics during the COVID-19 pandemic. First, we see that the COVID-19 pandemic had a brief negative impact on the fintech market transaction in Indonesia, but the market has started to recover, gradually recover in July 2020. Can you move to the next slides, please? Right. So it is shown in Figure 1. We can see that it seems that the COVID has only a brief impact on the fintech payment transactions. Please return to the previous slide. Now the previous slide. Okay. The next one is the pandemic has caused the value of electronic money shopping transaction to get closer to those of the credit card and the combined ATM card and the ATM plus card. It is mostly driven by the decline in the use of the credit card and the combined ATM and ATM debit cards. So please go to the next slide. It is displayed in Figure 2. The electronic, I'm sorry, the previous slide. Right. Okay, the electronic money is pictured in the green line, and then we see that the credit card and the ATM plus card in the yellow line. Please return to the previous slide. Right. The pandemic briefly harmed the peer-to-peer fintech lending from April to July 2020. The new and outstanding P2P fintech lending has started to increase, however, beginning in August 2020 as the economic activities gradually resume by the end of the PSBB policy. And then the quality of the P2P lending, in fact, had deteriorated long before the pandemic and worsened in the early phase of the pandemic. However, the P2P lending quality started to improve since September 2020. Please go to the next slide. Point number 3 and also to the next slide, please. Okay, point number 3 and number 4 are displayed in Figure 4 and Figure 3 and Figure 4. So please go to the next slide, please. Right. Now, other types of fintech products in Indonesia, the equity crowdfunding, in fact, grew strongly during the COVID-19 pandemic. The OJK reported that 3 fintech, ECF fintech companies had helped 111 SMEs to raise 150 billion IDR funding from almost 17,000 investors. Other report shows from the Fintech Singapore in 2020, there are several major acquisitions that have taken place in 2020, including the acquisition of Mocha by Gojek and other companies. There are also talk about between OVO and Dana in the process of negotiation, merger negotiation. This corporate action showed that the COVID-19 pandemic did not halt Indonesia's fintech industry from growing. Another report from the Medici said that there are more than 77 fintech funding investment deals that amounted to $329 million in 2020. So it shows that investors are still optimistic about the prospect of Indonesia's fintech industry despite the COVID pandemic. Please go to the next slide. Now we talk about the regulation. There are many regulations, but that the government, the OJK and Bank Indonesia issued to deal with the COVID pandemic. But there are two important regulations that are specifically designed for the fintech industry during the pandemic. The first regulation is issued by the OJK that allows, that includes the P2P fintech lending companies as part of the non-bank financial institution, the NBFI. The consequence is that this kind of inclusion, the fintech companies are allowed to restructure lending with borrowers whose businesses are harmed by the pandemic. The second regulation is the OJK allows the securities-based fintech crowdfunding. Before this regulation, the OJK only allows equity-based crowdfunding. So this is, like after this regulation, the crowdfunding can be based on the debt securities such as the government bonds, or we call it the SUN, and Islamic debt securities or the Sukuk. The new regulation also allows the MSME to do fintech crowdfunding. Initially, before this new regulation, only the fintech companies that is registered by the OJK can do the crowdfunding, and then they were only allowed to be based their businesses on securities. Please go to the next slide. Now this is more case study. I make a model that to investigate the impact of the COVID-19 pandemic and the PSBB policy on the Indonesia's fintech market. Due to the availability of the data, I can only do make models for two types of fintech markets. The first one is the fintech payment, and then the second one is the P2P lending. There is no data on crowdfunding. There is no publicly available data on the crowdfunding and other types of fintech. So back to this, I create 10 models to investigate, to examine the impact of the pandemic and the PSBB on the fintech payment market and then P2P lending market. The generic form of the model are presented here. So we have control variables, and then we have the COVID variables itself, which in one model is stated as the dummy variable, 0 for period before the COVID and 1 after the COVID period of the COVID. And then in other model, it is stated as the second order difference of the new cases of new daily cases of COVID. It is made as a second order difference variable because of the stationarity issue. So in order to tackle the stationarity problem, we have to differentiate it twice. And then the third variable is the PSBB. We have 0 for a period before the PSBB, 1 for the period during the PSBB, and then 2 for a period after the PSBB. And then we introduce also the interaction variable to between the COVID dummy and the other variable in order to know the impact of particular independent variable, the impact of the COVID-19 on the relation between particular independent variables such as the per capita GDP with the dependent variable. The regression results are displayed in Appendix 1 and Appendix 2. So please go to the next slide. I'll just go to the result. All the 10 models that I create show that the COVID-19 variable either stated as a dummy variable or as a second order difference daily new cases variable is not significant in all models at 5% significance level. It implies that the pandemic does not significantly impact the transaction values of all types of fintech payment products in Indonesia. The pandemic also does not significantly impact P2P fintech lending. In other words, Indonesia's payment fintech and P2P fintech markets are resilient to shocks coming from the COVID-19 pandemic. However, the results also show that the claim that the COVID-19 pandemic accelerates fintech development is not supported by empirical data. The COVID-19 pandemic does not significantly weaken nor strengthen the relations between per capita GDP and phone banking, internet banking, and electronic money transaction values. The pandemic weakens the impact of the real GDP on per capita real GDP on P2P lending values. Sorry, real GDP on P2P lending values, but such impact is very marginal, or if not negligible. So please go to the next slide. Now we talk about the dummy variable on the PSBB. So here we discuss about the PSBB. The PSBB dummy variable is statistically significant in all models at 5% significance level, except in model 3, where it is significant at alpha equals to 10%. Holding other factors unchanged, the PSBB reduced the phone banking, mobile banking, and internet banking transaction values. That said, the PSBB increased the use of electronic money, assuming that other factors are unchanged. The PSBB also reduced the new P2P fintech lending because fewer economic activities were allowed during the PSBB, and because household consumption weakened, so the demand for P2P fintech lending fell. The finding that the many households switched their payment method to electronic money cards is similar to the finding in TUT study in the case of Kenya. Please go to the next slide. Now, here we discuss about what the government has done in order to use the fintech, to utilize the fintech to support the economic recovery. So the Indonesian government has included and utilized fintech companies in its National Economic Recovery Program, or the PEN. For instance, the Indonesian government launched the so-called pre-employment card, or Kartu Prakerja program, where different fintech companies play two different roles. One plays as a fund distributor, and the other plays as the course provider. Having said that, I still see that there are many rooms where the government can utilize the fintech companies more to support the economic recovery, such as using the fintech payment companies to transfer direct cash transfer fund for poor household, and to use the P2P fintech lending companies to provide subsidized loan for the MSMEs. Next slide, please. All right, this is the next slide. This is the last slide, okay? Indonesia's fintech market is relatively resilient from the COVID-19 pandemic, but we show that the COVID-19 pandemic, the claim that the COVID-19 pandemic accelerates Indonesia's fintech market development is not supported by empirical data. The PSBB has negative direct impact on the phone banking, mobile banking, internet banking transaction values, but it increased electronic money transaction. And the PSBB also harmed the peer-to-peer fintech lending. And the relatively short PSBB period had prevented the fintech market from taking too many negative impact from restriction in economic activities. And then Indonesian authorities have involved and utilized fintech industry to support the National Economic Recovery Program, but there are many rooms where the government can utilize the fintech industry further. And then the last one is the importance for the BI-OJK and the government to develop and maintain a shared database and mapping on Indonesia's fintech industry. And then, if possible, it is better if they can also publicly share the data on other types of fintech products, such as the crowdfunding and other type of fintech product. That's all for me. Thank you.
Thank you, Eric. Thank you, Eric. And you've saved time. You've only used 15 minutes. So now let me call on Dr. Hasanul Bana. Dr. Hasanul Bana is a research fellow at the University of Malaya in Malaysia to discuss Eric's paper. Dr. Bana, the floor is yours.
Hi, yeah, hi.
Hey.
All right, let me share my screen. Can you see?
Yes.
Okay. I mean, yeah. Okay, sorry. Okay, thank you very much, James and Eric, for your presentation. And And thanks. It's my pleasure to be here as a discussion this time. Okay, the paper title is the topic, the COVID-19 pandemic and the Indonesia's fintech markets. So this is basically the objective of the paper is you see here, is investigate the impact of the COVID-19 pandemic and the large scale social distancing, which is in short is PSBB policy on Indonesia financial technology markets. It also elaborates the roles that fintech companies can play in the national economic recovery. So basically, I have the general comments for this. It's really very interesting paper, and is of course is timely, and it talks about the COVID-19 pandemic, social distancing, and the fintech market. And the motivation and objective of this paper is very clear and straightforward. And I find the paper has a recent literature which is very up to date and is covered widely, and it also covered the Indonesia fintech market dynamics during this pandemic. So I have some specific comments. Hopefully that will help to improve the paper. You may consider this. So basically, I couldn't find what makes this paper different than others. So I suggest that if you want, I think you may include a paragraph in the introduction to explain the contribution of the paper, what makes this different from the others. And another issue, you have chosen from 1st of January 2014 to 31st of December 2020. But you didn't mention why you choose from 1st of January 2014, why not previously or not after. So I think this, you should briefly explain these things about the period and also the sample size. Though the sample size is written in the table, but it's not in the text. So I suggest you to a bit briefly explain about the data and the sample size and all those things. And another issue, you may have, look at some other channels, right? Like, you only interact with the COVID-19 period. Why not you just interact with the PSBB period and see how it works? I mean, how it affect on the relationship. And also you may consider the monetary policy. There's an interaction with the monetary policy and the COVID-19 as well as with the PSBB. And since you already mentioned in your paper, there's some new regulation for this period. So why not you just look at it and say how it affect on the relationship, like the interaction between the COVID-19 and the new regulation, and the interaction between the PSBB and the new regulation. So at least I know that finally I can say I really enjoyed reading your paper, and thank you very much for your paper and presentation, and thank you all. And that's all my presentation today.
Thank you, Dr. Bana. Back to you, Eric. Do you want to respond to?
All right. Okay. Thank you very much for the feedback, Dr. Bana. And then, yeah. On the first point that what makes this paper different from other papers, I will surely include that in the revised paper. I will add one para explaining what's the difference. And then why did I choose the 1st of January 2014? It is because the available data from the OJK on the and from BI for the fintech industry starts from late 2013, but it's better for me to start from the first month of the first date of the year, right, 2014, and then look in other variables. Yes, I've tried, and then when I try to use two interaction variables, for instance, the PSBB versus the per capita GDP and COVID and per capita GDP, I encountered multicollinearity problem. So the VIF is greater than 10. So I have to choose which one, PSBB or COVID. And then, yeah, but if needed, I can just present both results as well. But yeah, on the monetary policy side, yeah, I've tested as well. But the BI rate itself is not can be represented by the lending rate of the bank, because they move in tandem. So yeah, so I already include that. So thank you very much for your feedback. Now there is one question from Achilles Kurma Sarma. What are the factors that cause brief negative impact on the pandemic on fintech payment transaction? I think most of the problem comes from the deteriorating people's purchasing power. So because of that, they reduce their online transaction as well. So that is why this is one of my motivation to test whether the claim that the fintech industry is boosted by the pandemic. It seems that the empirical evidence does not show that. Yet we can say that the Indonesia's fintech industry is resilient from the shock coming from the pandemic. That's all from me. Thank you.
Any other question, Professor Sudawe?
I have a question.
Yes, I also have a question here. My question really is the relationship between the pandemic and the PSBB, because the social distancing restrictions are directly put in place because of COVID. So it's really quite difficult to say that the pandemic did not affect the fintech when your finding actually shows that the PSBB has a very significant impact on the pandemic.
Right. Indeed, but you know that the after the PSBB was lifted, the pandemic still goes on, right? And then it seems that it doesn't really impact the impact of the pandemic itself on the payment transaction and peer-to-peer lending is not was not as significant as when the PSBB was in place. So I guess yeah, the PSBB is a consequences of the a way to, or an attempt to curb the pandemic, but what really matters is the PSBB, because it restricts the economic activities and that directly impacts the people's purchasing power as well as the business activities of firms. That's my take.
Yes, maybe my response to that is maybe because the COVID was implemented via a dummy variable, right?
Yeah.
Yeah. What if you've used, for example, COVID cases?
I did. So there are in model there are two types of model 1 to 4. I use the dummy 0, 1, and for the second model I use the actual daily new cases. But there's a problem with the level data, so I have to do second order differencing because of first order that doesn't work. The data are not stationary, so I have to do the second order differencing. And then by using this data, it shows that the PSBB, the daily cases, is not significant.
Okay, thank you, Eric.
Thank you.
John?
Yes, thanks for the presentation, Eric. I just had a question about your finding that COVID had no impact or no significant impact on fintech across all of your models. Is there any further insight on that? So is this basically related to the fact that fintech markets in Indonesia are already at a particular level of development and people are already using these types of payments, etc., that the COVID shock didn't really have any significant effect, or is there any further implication?
Right. I would, for the time being, I can only give you a hypothesis that the level of the financial literacy of Indonesian population is not that is not as high as, say, like Singapore or other countries. So when they are the COVID strike the economy, they are forced or compelled to use the fintech just as a temporary measure. It's not really that they are willing to change their habit from using the cash or credit card or debit card or other things to fintech product. But we will see what will happen because one comment in the paper that comes from the head of the fintech association himself said that the switch to EM electronic money seems to be temporary, because after that, after the PSBB is lifted, then people go back to the way they use the transaction method. So
Okay.
yeah, I have to test that. I mean, maybe in the next paper, whether the financial literacy has impact on this.
Yeah, so there are implications for the financial literacy then as well that you could delve into further. Yeah, okay,
right.
Thanks.
Thank you.
Thank you, John. Thank you, Eric. Now we close the session for the first, we close the discussion on the first paper and proceed to the second paper. The second paper is about COVID-19 digital transactions and economic activities, the puzzling nexus of wealth enhancement, trade, and financial technology. And we have with us Mohammed Ayub Khan Nihar, who is an economic advisor from the Employers Federation of Pakistan, to present the paper. The floor is yours, Mohammed.
You're on mute. You're mute.
Yeah, Mohammed, I think you're on mute.
Thank you very much, and good afternoon and good evening to every participant. As an introduction, you have mentioned that the topic is COVID-19 digital transaction and economic activities, their linkages. In this study, basically, we have supposed that during the last 2 decades, the accelerated growth in world economy was closely associated with the globalization. And this globalization is being affected by the various measures to control our the spread of COVID-19. The problem is that what are the possible mechanisms that we can reduce or minimize the impact of anti-globalization measures on the world economic growth. First of all, we divided the global economic, the globalization factor into 2 different categories. In the first category, we have taken those measures which are directly related with the digital technology, including internet, digital payments, e-commerce, electronic money. Definitely, these are the main ingredients of the globalization. And I have mentioned that we suppose that globalization accelerated the growth in world economy. Second category covers the physical movement of peoples, goods, and services. And this second category is basically affected by the anti-measures to reduce the impact of COVID-19. The short-term restriction to counter the spread of coronavirus are basically affected through this second category. However, the accelerated and effective use of first category, I mean the components of first category, can reduce the impact of anti-globalization measures on world economy. This was the basic idea behind this study. Another position is that the criteria in financial economics we have been discussing, that the wealth maximization is the basic criteria for every action which are taken by the investors and policymakers. If the investors are agreed and they felt that the new measures, adopting the new technology, adopting the different financial technology can enhance their businesses, it enhances their end of period wealth, then definitely they will adopt all those techniques which make sure that their profitability will not reduce, their wealth will be enhanced. This is the basic criteria. We further in a hypothesis develop a nexus between 3 variables, 3 dependent variables. They have all interrelated to each other. One is wealth maximization, and wealth we have measure in terms of the market value of equities of the listed securities. Second variable, which are also a dependent variable, we determine its explanatory variable, is the trade in services. Trade in goods is also important, but at present we have noted that trade in services is much higher from the magnitude point of view as compared to the trade in manufactured goods and trade in commodities. So another variable we have taken is trade in services, and third variable is the growth in GDP. All these three variables we have hypothesized that these are interrelated variables, and based on the different evidences in economic literature, I have mentioned in the written text or written paper, and on observation in the current economic trend, inclination to use of financial technology, we developed these three equations. First equation, a dependent variable in this first equation is trade in services as percentage of GDP. We hypothesize that trade in services depend on the receiving money from digital sources, using digital sources to receive money. Second is buying through net internet. Third control variable is a foreign direct investment as a percentage of GDP. Fourth is a merchandising trade as percentage of GDP. And the last related variable is also a control variable, which is related to the monetary policy, is the domestic credit to private sector. In second equation, we estimated the market capitalization, which is a proxy of the investor's wealth, market capitalization as percentage of GDP. And we hypothesized that its explanatory variables is domestic credit to private sector in ICE countries, foreign direct investment as percentage of GDP, not this year, we taken its lag variable last year, because foreign direct investment, inflow of foreign direct investment affect to the market capitalization in the coming year, not immediately. Third is the merchandising trade as a percentage of GDP. And next is the trade in services as percentage of GDP. Then growth in GDP of ICE countries. Then using plastic money or credit card to buy. And then last is using internet to buying something. The last equation is IMF 1920. Basically, it is the GDP growth rate, which is estimated by IMF. Other variables, we have collected the data for other variables through World Development Indicators. But for this equation, we collected the data, we used the data from IMF. The reason is when we compare the pre-COVID GDP growth rate and post-COVID GDP report, this data was not available in World Development Indicator. However, IMF have estimated GDP growth rate for 2020 and 2019. So we taken the this data for this variable from IMF and hypothesized that the growth in GDP is depend on the existence of COVID, which is a dummy variable, equal to 1 for 2020 and 0 for 2019. Other variables, the buying through internet, then using card, plastic money for buying something, then receiving payments through digitals, then control variable is the domestic credit to private sector, short-term debt as a percentage of the total outstanding debt of ICE countries in each years, and total GDP of ICE companies, foreign direct investment as percentage of GDP, and the permission to commercial bank to issue e-money in ICE country. It is also a dummy variable, which explain that if this country has a permission to commercial bank to issue electronic money. This is this picture show the simultaneity in the model. Trade in services depend on inflow of these are the main variables: inflow of foreign direct investment, merchandising trade, receiving digital payments, use of internet to pay bills or to buy something online. And the other dependent variable is market capitalization of listed companies. We hypothesize that it depends on the inflow of foreign direct investment and merchandise trade and domestic credit to private sector. While growth in GDP directly dependent on the use of internet to pay bills or to buy something online, and the existence of COVID-19 pandemic. This is the simultaneity in the model. The data for estimation of these equations have been extracted from the World Bank, as I have mentioned already. However, the data of GDP growth for 2020 was not available in World Bank's data bank, but the International Monetary Fund has shown the estimate for 30 companies for 2019 and 2020. So in explaining the GDP growth, we applied the IMF data. And to capture the effects of COVID-19 on GDP growth, we created the dummy variable, as I explained, which is equal to 1 for 2020 and 0 for 2019. However, the data for the permission to commercial bank to issue electronic money was extracted from the Global Financial Development Report. This report was published by World Bank, and World Bank collected this data through a survey. And we incorporated this variable through, again, a dummy variable. We created a dummy variable, which is equal to 1 if commercial bank in a country are permitted to issue e-money, including prepaid e-money also included in this. Similarly, the data on the use of debit and credit card to make a purchase and use of internet to pay bills or to buy something online, and receiving digital payments from self-employment through a mobile phone and sending remittances through a mobile phone have been extracted from Global Financial Inclusion and Consumer Protection Survey. This survey report was also published by World Bank in 2017. We applied this report that in which countries these facilities are being used and available. In estimation, we have noted that in an estimation of the trade in services, the received in digital payment in the past years was very significant variables. This independent variable was tested in different alternative scenarios, and in different scenarios we found in any scenario it was a significant variable. However, there was a problem of multicollinearity between these two variables. First is received digital payment in the past years, and other is used the internet to pay bills or to buy something online in the past year. These two variables are interconnected. Basically, when someone buys something on internet, it is usual practice where to buy through internet, you will have to put your credit card. So if you have a credit card, then in most of the cases you can use internet option for payment. So obviously there is a multicollinearity, but in first two options, we tested received digital payment, and another option we used internet use of internet. So on both the way we tested these variables. The net inflow of foreign direct investment was also a significant variable in determination of the trade in services. Similarly, we have noted that merchandising trade has also close and significant association with the trade in services. If a country has higher magnitude of merchandising trade, the magnitude of trade in services will also be higher. These results have also been tested for 2018 also. We applied cross-section data, and for 2018 we estimated a different relation. For 2019 we estimated different relation, but there is no falsification in our main variable. Our main results were accepted in both the cases. I will explain in the last slide. Next variable was the market capitalization, which is a proxy of the investor's wealth. In this model, again, domestic credit to private sector was a very significant variable. Net inflow of GDP in last year affected positively to the market capitalization in the current year. Merchandising trade as percentage of GDP was also a significant variable. However, in this result, we noted to some extent, that trade in services is has a negative relation with market capitalization, which is something against the common initiative, against the common opinion. And we need to explain that what are the reasons behind this. I tried to explain this in the conclusion part. These results are again, we estimated separately for 2018, and almost the same result we have found in this case. In estimation of GDP growth, we estimated, we applied a pool ordinary least square because of 2000, if we applied these results separately, run a regression for 2019 and 2020, there was a less number of observation. So we applied pool data and we compare both the years, that how COVID-19 affected to GDP growth, to check the robustness in the parameters and to apply some falsification test. We estimated 8 alternative models here. 8 alternative models we have applied here, and their results are presented in these tables. And all these 8 alternative models, one thing was very clear, and with the robust parameters, that COVID-19 have significantly negatively affected to the GDP growth in all countries almost. To incorporate this variable, we applied dummy variable equal to 1 for 2020. It is significant in all 8 alternative models. Similarly, another interesting result is that use of internet to pay bills or to buy something online in the past years, as percentage of population of more than 15 years age, it was also a significant variable which improved GDP growth. And obviously the root of this GDP growth is the trade in services and goods through internet buying. And use of debit or credit card to make a purchase in the past year was also a significant variable, but surprisingly its sign was negative, which is again something against the common intuitive. The other alternative models are here, and you can note it. You can note here that the results are almost significant and robust, and is similar in all 8 models. Statistically, if we see the statistical parameter, the adjusted R square and F statistics show goodness of fit in all estimated equation. Obviously, these are the indicators that explanatory variables included in the model significantly cover the sufficient effects. The robustness in estimated parameters have also been checked by using the alternative option, and you have seen that results are robust. In determination of GDP growth, it is envisaged that COVID-19 has adversely affected GDP growth, but use of electronic money during pandemic crisis may compensate the economic losses to some extent. The parameter attached with the use of electronic money is lesser than the parameters attached with the COVID-19. COVID-19 affected at a large scale to the economic growth, and to some extent, the more use of electronic money may cover these losses, but not 100% recovery is possible because its parameter is less than the COVID parameters. To test the impact of COVID-19 and the use of electronic money, we have established same model in different scenarios, but the negative and significant effect of COVID-19 was not falsified in any case. The impact of the use of internet for paying utility bills or buying something on GDP is significant in all scenarios. Empirical evidences show that higher share of population receiving money through internet or use of internet payment of bills or to buy something online are significant and robust in determination of the trade in services. However, both the independent variables cannot be used simultaneously, as I have mentioned, because the multicollinearity. The impact of FDI merchandising trade are also positive on trade in services. The role of domestic credit to private sector is not significant in determination of trade in services. However, we noted here that it is highly a significant determinant of the value of investors' funds. It is a general thought. Generally, particularly in developing countries, we recommend that more credit to the private sector can be helpful for improvement in trade in services, particularly the services related with the information technology, with education and health services and travel related services. It is a general perception that more credit to the private sector enhance these type of activities. But empirical evidences have not supported this common opinion. But this expansion in credit to the private sector is significant in determination of the value of investors' wealth. The merchandising trade also enhanced the wealth of shareholders. Its results is again statistically significant and consistent for both the years 2018 and also for 2019. In last, these conclusions spoke to the promote e-money and digital transaction in the economy. Obviously, it is obvious which have been shown in the result. So far as concerned, the common initiative that enhancing in the domestic credit help the services sector, it was not proved in this study. However, we have noted that it is a significant variable in wealth determination. In interpreting the significance of credit to private sector in determination of trade and GDP growth, it must be in consideration that domestic credit facilities to manage working capital or liquidity requirements may affect to the growth in next year. It may not affect growth instantly. If banks or other financial institutions provide credit facilities to the industries or business sector, definitely it will take some time. They may affect in the coming years, but not in the same year to improve the profitability of business or to improve the GDP growth in the same year. However, improvement in liquidity position by enhancing domestic credit may ensure the sustainability and continuity of business activity. And such activities may be important for future. We have noted that during the credit, the crisis of COVID-19, there are many countries which adopted these policies. They adopted soft monetary policies and enhancing credit facilities to their private sector to ensure the continuity of their businesses. The effects of last year's foreign direct investment on current year's wealth of shareholders was significant for 2018, but it was not significant for 2019. It may be, in fact, the relation between shareholder and foreign direct investment. Obviously, it is not too simple. The timings are important. Timing may be important in determination of this relation. Sometimes it may affect to the shareholder wealth in the same year, but sometimes it may not be affected. It depends on the other economic condition in the years. What is the stage of the business cycle? What are the other crises? What are the global economic trends? They may determine this relation. Foreign direct investment may affect the value of shareholder wealth in different years, depending on the global and national economic conditions.
Mohammed, do you want to wrap up?
Yeah. The negative impact of buying through debit and credit card on GDP growth is not understandable. Probably it may be cause of high multicollinearity between these two independent variables. Thank you very much. I concluded.
Thank you very much. And now I call on John to discuss the paper. John, the floor is yours.
Yeah. Yes. Thank you, James. Wait. Okay. Okay, so thank you very much for the presentation. I just have a few comments and suggestions to hopefully improve the paper. I think it's a very topical topic itself. So the comments that I have, I hope will be able to sharpen it a little bit. But first of all, to provide an overview of the main points of the paper. First of all, it sets the scene by highlighting the large GDP losses across various COVID scenarios that may take place over the next 5 years. So this is by way of motivation. And it also provides an empirical analysis of the impact of COVID-19 on GDP and the implications of digital finance for that. The analysis is based on a global sample of up to 155 countries, depending on data in different specifications. With the main finding, I think that COVID-19, while it has dampened GDP growth, this has to some extent been offset by digital finance. And digital finance have been shown to robustly underpin trade and services, and there's a further analysis done on the implications of fintech for shareholder wealth. I think the main equation that I'd like to focus my comments and suggestions on would be the third equation, so the one that looks at the COVID-19 dimension and its impact on GDP growth. I think this is an area where, of course, there's great interest, and it's a focus of the conference today in terms of the digital finance interrelationship with that. So I think what's missing from the paper is some discussion on fintech growth and basically e-commerce payments data. So what's used in the paper is a dummy variable, not only for COVID-19, but also the digital finance side is also reflected as a dummy variable to my reading of the paper. And I think it would add to not only the motivation for the paper, but also it would improve the specification of the regressions that were carried out by using actual data as opposed to relying on numerous dummy variables. And the charts here just set the context for the rapid growth that we've seen in the use of these types of digital finance solutions for Asia. So in terms of comments on the paper precisely, I think that as opposed to what was stated about the approach being a simultaneous equation modeling approach, I think what we have is 3 discrete equations estimated separately. So that needs to be clarified. Just adjust my screen. That needs to be clarified in the paper a little bit. And the main equation of interest uses a dummy variable for 2020 to capture COVID-19. But I would ask, what about using actual cases? Because this data is also available. So it would be interesting to see if the results are robust to using actual cases instead of this dummy variable approach. I think what's important to add to the paper would be the interaction effect of COVID-19 with the fintech variables, because this allows you to assess the impact of the digital finance revolution, let's say, in the face of COVID on GDP growth, assuming GDP growth is the determinant variable, the dependent variable. So these interaction effects are not a feature of the analysis, and I would encourage the author to include that. It would also be of interest to take a longer time dimension. I think that data is certainly available for that, and it would be of interest to see how that affects the results, as well as looking at different country groups as opposed to looking at an overall global sample. I think that more work is needed on specifying this COVID impact. So as well as looking at the interaction of COVID-19 with the fintech variables, it would be interesting to see modeling with higher frequency variables and possibly even an alternative approach. And that might even involve replacing some of the variables or interpolating some of the variables, but I think it would be worthwhile to do that. As I mentioned earlier, the paper seems to be structured around 3 different equations, I would suggest to focus on the equation number 3 and integrate the other parts into that equation. So services, trade, and shareholder wealth could be on the right-hand side of that single equation instead of having this 3-pronged approach, which also makes the research question itself a little bit blurred. So by doing it this way, it would clarify the research question. So make it purely about COVID-19, fintech, the interaction terms, controlling for services, trade, shareholder wealth, and all of the other controls there. And on the left-hand side of the equation, you have GDP growth. Yeah, as I mentioned before, fintech-related variable seems to be binary variable. Yeah, so I'm not 100% sure if that's the case, but that seems to be the case. And I would encourage the author to seek actual payments data, at least for robustness, but also I think that the results would be much more informative than using the binary dummy approach. So the suggestions, therefore, would be to reframe the research question. There's a lot going on in the introduction, a lot to read and so on. And I would say that it would be much more useful to reframe it in a simpler way. And the question could be framed around quantifying GDP or output losses under COVID-19 and the mitigating impact, at least testing the mitigating impact of digital finance. Specifically, the coefficient of interest under that type of modeling approach would be the interaction of COVID-19 and digital finance. So basically, we would expect a negative coefficient on the COVID-19 variable and the reverse for the interaction term. Thirdly, as I mentioned earlier, it would be useful to add an additional time dimension to the framework and a higher data frequency. So this might involve replacing some of the variables to those which are available at a higher frequency, and or interpolating some of the lower frequency variables to enable more observations. At the very least, this should be done for robustness, but possibly as the baseline. Yeah, next point, compare results across different regions. So the analysis is carried out purely at a global level. And this doesn't lend itself to policy implications that can be useful at the regional level. So it would be interesting to split the global sample down somewhat. Next point, it would be useful to provide some insights on the counterfactual. So the impact on output in the absence of digital finance solutions. And this can also be carried out using the framework suggested and can be an interesting insight to the importance of digital finance, particularly in the COVID-19 period. Yeah, second last point is on deriving policy implications, which I've already mentioned. And then the last point would be to extend the analysis to the post-COVID-19 recovery phase, data permitting, of course. So that would be interesting to also include. Of course, there are additional problems with that, given the permanent output losses that we've seen from COVID. Of course, we've now returned to a situation with GDP growth where it's even greater than what we had before COVID-19 because of the reduction in the trajectory of GDP caused by COVID-19. So using GDP growth as a dependent variable in the recovery phase may not be entirely useful as a gauge of recovery, but I mean, this is a problem for every econometric modeler going forward. So they would be the suggestions that I have, and I'd be happy to discuss further either in this conference or on a bilateral basis. Thank you.
Thank you very much. John, thank you very much for your excellent recommendation and suggestions. And I hope that you will share these presentation with me so that I can incorporate your good suggestions. So far concerned as binary variables of fintech related variables, One variable is binary, and the other is a number of pupils, population, where is hard data. Only one variable was binary, but I will check and I will definitely incorporate your all good suggestion. And thank you very much. I am really impressed with your good and excellent suggestions. Thank you.
Thank you. Thank you very much. Yeah, I'll share the slides, of course.
Thank you.
Okay, so with that, I think we can finish early and come back at 10 minutes past 6. So in 20 minutes, that's Tokyo time, of course. So in 20 minutes from now, we will start with paper 3. Thank you very much.
Okay, welcome everyone to the third paper for session 1. And for the third paper, we have John Vong, who is the Principal Consultant Managing Director of the International Center for ASEAN Management, who will deliver a paper on formulating a fintech strategic roadmap to spur a post-COVID inclusive recovery. John, the floor is yours.
Okay, thank you. Good evening, everybody, and thank you, James, for that wonderful introduction. I shall keep within my 20 minutes, and I won't want to go across the time for you to, because you will have dinner very soon, I suppose. All right,
yes,
but
yes.
Let me start off, let me say what I've learned from the previous speakers. I've learned from Executive Director Brian Zhang that digital tech is the only way that economic activities can be done during COVID-19, and many people have been using it. And even most of us on this board here on a panel would have used it. And from Professor Zwan, I heard about sharing of data, and that is exactly at the crux of fintech, the sharing of data. The data that is right now in Australia, they're talking about open banking. And also as in the emerging markets that I've been to, and I've gone to the emerging markets of Cambodia, of Thailand, of Indonesia, they are talking about open banking too. And open banking, it starts with sharing of data, without which you can't open the banks, all right? From Baba Eric, I've heard that there, of course, he's talked about also sharing of the database, but what is more interesting in his research is that COVID-19 has no significant impact. And he is saying possibly is due to literacy, the level of literacy in Indonesia. I have one more thing to add to that, and that is the number of unbanked people's group in Indonesia. At the last count, there are 75 million people without bank accounts. And because they're without bank accounts, they will never be being tracked in the financial system by the banks or by the central bank authorities. There's no way you can track unbanked people, all right? So therefore, using a fintech, so far, a lot of people have been talking about people who are already banked, who already have smartphones. What about those that do not have smartphones? Okay, and from Mr. Muhammad, I've learned something that is, of course, he has used a very mathematical equations to try to prove certain points, and that is valid. But John Byrne has given many suggestions of how the model can be improved. Now, my paper has a different slant to it, and mine is more on financial inclusion. Is more on financial inclusion and how fintech can hook itself onto financial inclusion so that there is a recovery, there can be a more inclusive recovery can be made. And I'm sharing some slides now. If you look at my slides, there are 3 publications given in there. The first one, Emerging Technologies from Emerging Markets, that was published in 2015. Now, that talks about banking without banks. Then that book talks about education without schools. And that talks about health without hospitals. And for a while, that book, while it sounded interesting, but however, the idea seems too far-fetched. that you can have banking without banks, and education without schools, and health without hospitals. Then came 2018, the book that is based on a conference proceedings that was organized by Cambridge Center. And it talks about the future of finance in emerging new hubs and new landscapes. And when I read it, I found it very interesting because it gave life to the first publication of 2015. And then came 2019, 2020, we talk about the COVID-19 fintech market. And there's another publication that's done and is organized by the World Bank Group, and of course, Cambridge Center is in there too. And what is interesting is that this has a flow in it. All these three publications has a certain flow in it. It talks about things that is yet to come and it has arrived. COVID-19 forced the students to go for education without schools. It forced people to transact without banks. And it forced people to quarantine at home without going to the hospitals. So you have all the three combined with COVID-19. And because of that, it caused a leap in my heart. And I say, hey, we need to really seriously do a paper on this and see what is in store for regulators. How must they react in a COVID-19 or post-COVID-19 environment, and what fintech can do, and how to have a more inclusive recovery. So I started the paper with the aim to guide financial regulators to form a comprehensive roadmap with an emphasis on a broad-based, inclusive post-COVID-19 recovery. So my paper is targeted towards financial regulators, financial authorities, or people who are in the legal field that needs to think something along those lines on policy and regulations. And the method I've used is an exploratory approach to include service delivery to the underserved and underbanked, especially. And I'm looking at countries like, specifically, Indonesia, where you have estimated 75 million unbanked. And you have Myanmar, an estimated of 40 million unbanked. And you have other countries too, that's in emerging markets. So I look at the desk reviews and the reports that came up from ADB and CGAP and IMF, UNDAF, World Bank Group, and specifically I look at the policies and regulations in Cambodia, Indonesia, Singapore, and Thailand. In fact, I even rang up certain financial institutions that they are readily to be interviewed. So I held focus group discussions with some of these bankers. And the findings came out where there were three main themes. First of all, let's go back to the financial technology services that are needed and will be of need in the very near future. Second is the enabling technologies that must come about to ensure that the financial services are being delivered. And finally, the thirdly, is that of policy enablers. What are the possible policies and regulations? So let me go to the next slide. And very quickly, the financial technology has become a buzzword for a new era of digital-driven banking. So fintech has always had a aspect of digital-driven around it, and is driven around financial services and is online either by mobile banking or by a computer. And it will affect the back-end processing of the bank, and therefore promoting the utilization of blockchain. fast forward, that would be the case. On a more scholarly definition, I would put it as fintech is defined as encompassing advances in technology, which changes the business models and have the potential to transform the provision of financial services through the development of innovative instruments, channels, and systems. What about financial inclusion? Financial inclusion, provision of access to financial services to all members of the population, particularly the poor and other excluded members of the population. It can also be defined as the delivery of banking services at an affordable cost to a vast sections of disadvantaged and low-income groups. All the definitions have one thing in common, which is the emphasis on the population that should have access to available financial services that they are not getting it right now. So if you look at the Cambridge Center report for 2018, there were 4 key findings in there. That the Asia and America takes the lead in the fintech hubs. That practice precedes regulation. Practice precedes regulation, leading to chaotic development. I'm not sure about the word chaotic, but practice definitely precedes regulation, as it seems as can be seen in some countries. That is already happening. That many fintech companies started offering services, and as yet there are no regulations to govern them. And therefore, there's a need for sandboxes. Many banks I've spoken to in the emerging markets, they say we need to have this sandbox. Singapore, of course, is a front runner. They created the sandbox. But there are many countries that have not even a sandbox, haven't created, and there are no laws and regulations to govern it. Number 3, the traditional financial institutions embrace fintech. Some of them embrace it reluctantly. I've spoken to some chairmen of the banking corporations in Asia. They say, we have no choice, we have to go along. Really, by themselves, they're happy just to do the bread and butter part of the banking. But because of this new buzzword, the fintech, and the convenience that it has served, they can see that there's a possibility that they can get into it. Otherwise, they'll be left behind. And the fintech adoption rate is gradually increasing. All right, so those were the key findings of the 2018 report. The 2020 report, they had surveyed 1,000 over fintech firms operating in 169 countries. Well, this study finds that overall, fintech operations across the globe have grown, although subject to several operational challenges. And 12 out of the 13 surveyed fintech verticals reported growth on an average compared to the same period, 2019. So it is growing, and is growing steadily and gradually. And fintechs are more nimble, of course, innovative in adapting to market conditions by both tweaking existing products and services. A case in point is P2P lending. P2P lending, bypassing the banks. Now, P2P lending, I've spoken to many people, and they thought it's just one person to one person. It can be a group to one person. It can be a group to a group of persons. So it can be one-to-one, and many-to-one, and one-to-many. So P2P lending has gone really well in some countries. So looking at all the desk reviews, and after asking many bankers exactly how they feel about fintech and what are the possibilities, if we were to talk to the financial regulators, what do they want us to say to them? So we came up with these 3 pillars. of the fintech development roadmap. On pillar 1 is about the fintech activities or the services. So you have digital banking services, insurance tech, you have crowdfunding on loans, you have equity crowdfunding as well, you have e-money and digital payments. The digital payments far exceeds all the others, far exceeds. If you look at some of the countries I've been to, like Cambodia, you have Wings Cambodia that is going far ahead. Then they have 10 million people operating or using that service. Your pillar 2, the enabling technologies. That's where we talk about APIs. We talk on open banking initiatives. And with all this shared data, once you have open banking, you have shared data. What about privacy? What about cybersecurity? What about cloud computing? Not every of the fintech organizations can keep a large server right at the back of their office, running 24/7. Some of them definitely will need to keep some information in the cloud. But the financial regulators today, most of them says, no, you can keep confidential information in the cloud. So what about money laundering, AML, anti-money laundering? So all those are important issues. We have seen some of the Bitcoin there's used right at the moment, and then for money laundering, and there's giving the Bitcoin a bad name, and other cryptocurrencies as well. You have biometrics. You have all these coming in as enabling technologies to make sure things move towards the fintech development. Pillar 3 are the policy enablers. What policies, what regulations that must be in place? Many bankers I've spoken to in the emerging markets, and they say one thing, is that they are ahead of the financial regulators. And the financial regulators do not know enough to write regulations that allows them to move in an agile manner. And more so, especially those who wants to move into financial inclusion, to reach into the unbanked and the underserved markets. How do they do it? So my paper is targeted towards the readers of those financial regulators and central bank authorities. Yeah. Their financial inclusion has been a major policy objective for many governments, but it's about time. It's about time they hook themselves on to the fintech and let the fintech gradually move forward, and it will also bring along the financial inclusion. And fintech is definitely a viable addition to the traditional financial structure. The fintech companies can close the gap between the unbanked, underbanked, and the underdeveloped societies. And that has been proven in many instances. Currently, the main digital finance services are payments, savings, and lending. But it's going to move towards the P2P lending. Once it moves towards P2P lending, it opens up a new ball game, a whole new ball game, and crowdfunding. And each country now should formulate their own fintech roadmap, covering specific local features depending on their specific state of the economy, especially in terms of the development or the depth of the banking environment. So I think my 20 minutes is up, and I want to thank you. And the whole paper, I will just repeat it and say it is, we want to encourage financial regulators to formulate the fintech roadmap for the post-COVID inclusive recovery. Thank you.
Thank you, John. Spot on, exactly 20 minutes. Now I turn on to Professor Ross Buckley, who is a Scientia Professor in Law, University of New South Wales. Ross?
Thanks, James. Thank you. Thanks. It's a pleasure to be here. And I enjoyed reading John's paper very much. I disagree with almost none of it, frankly. I agree with all of it. I think it's a very good high-level overview of what countries need to do going forward. I particularly like the focus on micro SMEs because I think, for most developing countries, that is where the greatest growth opportunities lie. I like the analysis of support measures as sort of a mixture of direct support for ecosystems, early government adoption of fintech measures, fintech financial policies, and innovation hubs. I'd speak to a few of these things, I think. Early government adoption of fintech is really important. And part of it is that it's a cultural thing. What we're trying to do is change a culture in how people deal with money. We're trying to get them comfortable with electronic payments, move them away from cash. Everybody knows how cash works. Everybody's comfortable with it. In most countries, still cash is king. I mean, in my own country, cash is now sort of dying out rapidly, but in most countries, cash is still king. If welfare payments or if government payments are pushed out electronically, this will force people to get used to electronic payments because they want to get access to their money. And once they get used to them, they'll find they're a lot more convenient. Also, the government will find they're a lot more convenient because electronic payments are auditable. If governments are not distributing social welfare funds electronically, there will always be some leakage. There'll always be some sort of corruption or problems like that. So there's big benefits for government directly, but the bigger benefits comes in sort of educating people about modern financial ecosystems, I think. So that government usage of electronic payments is a really important part of the decoding the puzzle. And it's in a lot of ways, I think it's got to be government. It's hard for fintechs themselves. Until government starts to use electronic payments, fintechs will encounter cultural resistance to a lot of what they're offering. Equally, for the government to use it addresses some of John's other points around digital identity. Digital identity is a really important foundational level, a foundation from which to build to make this sort of work. And you've got to have, you don't need something as sophisticated as biometrics, although biometrics is obviously where you're heading for in the long term. But you do need, a nation does need to wrestle with a functional digital identity, platform to be able to identify the people that the payments are going to. So in terms of early government adoption will bring along a level of digital identity, which is really needed for the whole ecosystem to work. That's what the ecosystem is sort of built on. Another one of John's suggestions for support measures were innovation hubs, and he talked a little bit about this in sandboxes in a couple of places in the paper. This is a big interest of mine. We've written quite a few papers on this. The phrase sandbox gets all the attention, but sandboxes are mostly like, it's an American word, it's sand pit in my culture. It's a place where little kids play. And I think it's taken off because of that sort of connotation. It's a term that sort of cuts through. But what it really usually is a waiver of regulations for businesses that meet certain criteria that allows them to do things less licensing or less regulatory burden than they would otherwise. And that's okay. And they have helped a bit in some places. But often what is termed a sandbox is really an innovation hub. And an innovation hub is somewhere that fintechs can go for advice, can talk to the regulators, can be guided in what they're doing. So Singapore is a standout example. Singapore calls what it does a sandbox. I would argue what Singapore really does is more of an innovation hub. And the distinction is really important because sandboxes are a bundle of waivers from a set of rules, they're relatively cheap to run. Innovation hubs are not cheap to run because you have have expensive expertise. Financial markets expertise is always expensive to buy in the marketplace, and the regulator needs quite a lot of it. And the Monetary Authority does it extremely well in Singapore, but I know in Australia, our innovation hub in our market conduct regulator is good and it achieves quite a lot, but it is grossly underfunded. They need a lot more people in there. The problem we have in Australia, which I think we have in a lot of, my research suggests we have in a lot of countries, is that governments seem to see regulation as a problem for business, as something that slows business down. So a lot of neoliberal conservative governments like to cut back on regulation, and that makes some sense mostly. But in this field, in fintech, regulation isn't an obstruction to business, it's an enabler of business. Fintechs need help in navigating the regulatory structure. And what was really interesting, a couple of years ago when the initial coin offering boom took off, if you looked at the beginning in Europe, it was scattered across quite a few countries, including small ones like Malta and Gibraltar and other places, and the UK and Germany. And a lot of the action in ICOs ended up in Switzerland. And it was the same in our part of the world. It started, spread across Hong Kong and Thailand and other places. But most of the action within 12 months had migrated to Singapore. And neither Singapore nor Switzerland are cheap places to conduct business, but they're both very well regulated places with very knowledgeable regulators who have the resources and the time to sit down and guide people. And the sort of fintech innovation that you want as a central bank is the sophisticated stuff by reputable people and those people will gravitate towards higher levels of regulation, not lower levels of regulation. But higher levels of regulation are expensive to provide. So one of my messages to government is if you want fintech to take off, you need to regulate it appropriately, not too heavily, but you need to throw resources at it because you need regulators who can guide the fintechs. And that's labor intensive, so that's expensive. And the final note I'd finish on is John in his paper talks quite a bit about open banking. I think it's really a good idea. It's obviously coming in a lot of there's context. Australia, I think, is an interesting case study. We're not there yet, but we've taken it a lot further. Open banking has been rolled out in Australia for the big four banks. But for us, it's an economy-wide measure. So it's called the Consumer Data Right. We're now rolling it out to energy companies. We'll take it into telecommunications. We'll take it into pensions. And eventually the goal is that consumers will control their data right across basically the entire economy. And that's not what's happened in Europe because it's part of PSD2, so it's related to payments. It's not what happened in the UK because there it's related to payments and banking. But in Australia, we're starting to roll it out across all sectors of the economy. And I think really banking isn't the most powerful place to roll it out because you can't quickly change banks. You can quickly change energy providers. You can quickly change a lot of provision of services if there's enough data for the new provider to be able to make a binding, accurate quote to the customer. The customer can then affect the change with a click of a button on an API. So I think, I understand why Australia's rolling it out first in open banking, but it's really the applications in some other sectors that have a greater potential to increase competition, I think. Anyway, I'm sure I've gone over time, so that's enough from me too. Thank you.
Thank you. Ross.
Thanks, Ross. Do you want to respond to John? Do you want to respond to Ross? You are right on time. We still have 10 minutes for Q&A. John?
Which John are you talking to?
You. Yes.
It's you, John. You.
All right. I want to thank Professor Buckley, for some of the words he has said, and he's given me some fresh ideas too, to add into the paper and to add a little bit more depth and the knowledge onto the paper, especially what you said about the innovation hubs that I think is very important. While sandboxes is something that is like a kindergarten playground, innovation hub sounds dead serious, and that's what we need to have. But not many governments understand the difference between the two.
No, they don't. They absolutely don't.
Yeah. So I appreciate all your comments. I want to thank you, Professor Buckley. Yeah.
Thank you.
That's all, James.
Now let me open the floor to questions. Let me look at the chat box.
Can I jump in?
Yes, please.
Yeah, because I'm from Singapore, perhaps I'm qualified to comment a little bit on that observation.
Okay.
And I'm not speaking from the policy point of view. I'm speaking from as a participant in this market. We actually have both what Ross says, sandbox and the innovation hub. And somehow MAS is behind both, because Singapore has a very unique component of financial sector development, which is run by the so-called regulator. We like to have a super regulator, right? Central bank, banking supervisor, and also try to bring financial sector into Singapore. So in actuality, we do have a sandbox. That is a sort of isolated environment for people to test out the fintech, because some of the fintech which will be interfacing with regulations, right? And that's very important. You have to somewhat isolate them until they are proven, okay, and give them a chance to nurture them. But innovation is completely different things. It may not have interface whatsoever with regulation. And most of my own work has nothing to do with no interface with regulation at all. It's all technological, in-house adoption. And many of the financial firm, when they adopt some technology, which has no regulatory implication at all. It just improve the process, and And so I think that's I'm just try to sort of add to the discussion. Sure. Yes, it's very important to have innovation hub, and that requires substantial resources.
Yeah.
The regulatory sandbox is also required, because for those technology interfacing with the compliance aspect of it, it must, right, to be given a chance to try it out, but in somewhat isolated environment. I hope that add a little bit. So Singapore do have at least both dimensions. Okay. Yeah.
Yeah. Thank you, Professor John. In some of the countries I've spoken to, the bankers, they have 2 central bank authorities.
Yeah.
And all of them are trying to regulate something.
No, John, here more than regulation. Here try to nurture the sector.
Yeah.
I have a question, John. In terms of the strategic roadmap for fintech adoption to spur inclusive development, one recent development in the COVID period was the application of fintech for G2P transaction, in particular in distributing social assistance. And I reckon that this has a very huge potential in terms of financial inclusion, because, for example, in Indonesia, they have the employment assistance card, which was basically developed using fintech technology. And this has the potential to really onboard informal, small micro enterprises and individuals, because it incentivizes their participation into the fintech platform. But once they are there, government can actually use them to actually formalize some of these small players. What's your view in terms of this aspect of the fintech market, which is quite new, the G2P?
Yeah. Thank you, James, for your observation. Well, what is more important, there are 2 groups of people, remember. One is at a high level. Those are the administrators and the regulators and the government types. And there's these are communities in here. And sometimes whatever they do up here at the higher level does not reach the community level. And I'll give you an example of the distribution assistance. I know of communities that do not have proper phones. And therefore, when they distributed the assistance, social assistance, through the mobile phone, these communities actually got cheated. Okay, so I'm going to do some real case studies, and I shall report this, really, because COVID-19 has brought a lot of scams, and I'm not talking about those sophisticated scams. It is simple things, like because the poorer communities do not have a smartphone. They don't have something that runs on internet. They have a dumb phone, 2G phone. Now, how are you going to distribute social assistance to this group? And there are 75 million of them just in Indonesia alone. Okay, so while what you've said is true, that the government can do a lot in the distribution of social services. But however, they need to really think through carefully whether it's reaching those communities that are unbanked, because that is the level that we must reach so that there is a inclusive recovery. Thank you.
Thank you. Any more questions from anyone? With that, we are actually 14 minutes ahead of time. So let me now shift to the next session, which is the keynote speech. So we have with us today, I don't know if I'll pronounce your name right, Penar Oskan. Penar Oskan is a professor of entrepreneurship and innovation at Said Business School, Oxford University. She is also the academic director of the Oxford Future of Finance and Technology Initiative at Oxford. She specializes in strategy, fintech, and entrepreneurship, and her research covers the use of AI, big tech platform, and digital disruptions in the banking sector. So with that, let me now invite our keynote speaker to deliver his keynote remarks. Penar, the floor is yours.
Thank you very much, James. And hello, everyone. Good evening over there. It's a bright and sunny morning here in the UK, which is rare. Before I get started, let me try to see if I can share my slides. If you allow me a moment. I hope you can see that.
Yes.
All right. So great. Again, it's a pleasure to be invited to this conference, and I have greatly enjoyed the talks before. And it's great to be thinking about the pandemic, fintech, and particularly in my keynote, I would like to focus on data-driven businesses, AI-driven businesses, and how they're reshaping industries and what this means, not just for fintech, but also for the future of banking and for the future of regulated industries in general, if you will. So with that, I'd love to start with a very quick introduction of a few different technology trends that, in my opinion, have enabled the rise of data-driven businesses that we see today. So just to start with, digitalization has been an important factor. It's been the main factor that disrupts industries in the last few decades. And even pre-COVID last year, ICT had predicted that 30% of large enterprises would be disrupted in terms of their business model, and digital and particularly platform based business models would be the main candidates as disruptors. And they have now updated that this is now over 50% because many businesses have had to either become digital or go out of business. Another important trend that we see, and this is based on some of the earlier research that I did on mobile payments, is that when companies go digital, they realize, and sometimes, unfortunately, they realize too late, that there are many opportunities to be connected and to be part of a digital ecosystem. And this is a challenge for traditional businesses that have not worked together, especially if they're dominant in their own industries. For example, large and established banks can be given as an example, and telcos, in the case of mobile payments, are entities that have, to a great extent, missed opportunities because they were not used to working in an ecosystem in a collaborative way. So connectivity and collaboration become very important concepts in this new world. As customers, when we look at it from the other side, we realize that we are generating much more data, especially now with the pandemic. We have reverted to mobile payments almost exclusively in many parts of the world. And even just before that, I'm carrying a smartwatch today. So when I get up after this presentation, I will be generating data. And as I speak to my family members, Alexa and Siri will be listening. And so all of that means that, as consumers, we generate data. And as we give this data to a great extent for free to enterprises, we are starting to understand that what we get in turn is better analysis and more tailored, more personalized services. So we are starting to demand more, as we should. And all of these trends together really emphasize how data-driven and AI-based businesses, machine learning businesses are starting to dominate the competitive landscape. And this is not a trend that is in the last 2-3 years. It's not a fintech trend. It's a larger trend in the sense that if you compare the largest companies in terms of revenue over the last, say, 10-15 years, you see that the traditional businesses like Coca-Cola or Marlboro back in the day, now it's hard to imagine, were the ones that actually dominated their markets. But already 5 years ago, the top cross-sector platforms, what we call big tech or GAFAM platforms, have become the largest firms in the world. And this trend is only accelerating now with COVID. And in particular, we see, as this will be a part of the theme in my talk today, we see that these firms are also disrupting now regulated industries. Why are they everywhere? They are everywhere because they take advantage of data in order to reduce transaction costs. They reduce transaction costs in search, in negotiation, payments. And so if you think about your Uber experience or a similar Airbnb experience or any experience that you have with a digital platform, you realize that data can actually help in many ways throughout that entire journey. And that's what we see around the world today. Platforms are also unique in that they grow extremely fast and they kill other platforms around them because they have what we call positive feedback loops, or we can also call them network effects, which is something that I'll explain in a minute. So when you compare competitors, traditional competitors in different sectors like BMW to an Uber, if your goal is to get from A to B, then you could buy a BMW to do that, or you could take an Uber. And what we see is that Uber, Airbnb, Facebook, and Instagram, which are the points of comparison here as digital disruptors, are firms that are extremely asset light. They don't own cars, they don't own real estate, they don't own content, they don't own photos, and this makes them particularly easy to scale up. And this is part of the issue that traditional businesses face when they start to compete with their digital counterparts. Network effects are everywhere. It basically means that, as I join a network, the value of that network for everyone else increases because I joined. Whether I'm an important or unimportant person doesn't matter, because there will be more connectivity in that network. But there's a particularly important part of a network effect, which is relevant here, especially when we think about digital platforms, which is the data-driven one. If you look at the upper right white circle, you'll see that as more users join the digital platform, there'll be much more data created. And this data doesn't just mean that there's more data available, but that means smarter algorithms, better matchmaking, better products that understand us better, simply better voice recognition, better matching between providers and suppliers, providers and users. And so overall, data-driven networks of effects are really giving rise to big tech as main players in different industries. So far, let's say if I had given this talk 5 years ago, I would have said, but largely regulated markets, they're not interesting for big tech. They're not interesting for these guys because they mean higher costs, and these guys want to be asset light. They don't want to be bothered by regulation, and therefore, they're going to stay out of it. And that's in fact what Parker, Van Alstyne, and Chowdhury, the kings of platform theory, have had said in one of their last chapters of their famous book, Platform Revolution. However, what we see is that that tide has changed. And so in a recent paper that I have published, I looked into how, in particular, regulated industries are being disrupted by data-driven businesses. And I give big tech as one of the examples, but I'll give you also the fintech today. So signs of disruption are everywhere in regulated industries, healthcare, education, and finance. And what I'll do today is I will focus on finance, but at the very end, I'll give a quick example of how healthcare is being disrupted as well. So jumping into financial and in particular fintech. So the idea that data is the main source of competition, a main resource that is needed for competition, is starting to click with competitors. And when you think about the financial sector, then the first question that we need to ask is, what can a new player do if they don't have access to data? Because as consumers, we don't like to fill out 10 pages of documents in order to give a new player data. We also get worried about what they might do with that data. We also don't always remember our salary or how much we spend. We give proxies, and half of the time, these are actually not correct. And so this made regulators really understand that in order for competition and innovation to pick up in the financial sector, and and it had been stifled for many decades, we need to put data in the center of it. How do we put data in the center of it? We put it in the center of it by making it available to new players. This is something that you all know very well. This is the core concept that drove the open banking and PSD2 regulations, now also coming to Singapore and Australia. And here's a map of the many places where these regulations are taking place at different speeds. And in a paper that I wrote with the Swift Institute coming out next month in April, we have compared UK and EU in terms of the implementation of open banking. And we have seen that a regulator that micromanages the process is actually quite important when there are different types of players in the market that have misaligned interests at the very beginning, which is the case, which has been the case in the case of traditional banks versus fintech. And so our new research actually shows that although leaving certain things to the market to innovate and standardize by itself may be a good idea in a nascent market, because all of the players are incentivized to make that market happen, when the market is established, but it needs to get boosted in terms of innovation, the regulator really needs to have a strong hand in the process. I'm very happy to share that research with you as well. So what we see is that open banking is starting to change things around the world. And in particular, we see an influx of fintech, and that is actually quite nice to see. But the picture is not all rosy. There are many issues. There are many ways in which collaborations don't happen. APIs don't work yet. But the future is very much one where access to data is going to drive the usage of machine learning as a capability for new firms. And fintechs are a great example of that. So how can fintechs use machine learning in order to give better services, better products to consumers? We say many examples, and here on the right, you see in the center of that circle, you see the HSBC website, but you see that there are many ways in which new fintech companies are attacking single businesses that are within single services that are within the HSBC portfolio. And HSBC is just an example, as you can imagine. And what we see is that financial services are being unbundled because access to data is allowing entrepreneurs to attack one area out of many. And I have collected a few examples here, and I've particularly given attention to bringing some examples that have become more important with COVID. So the one that was a basic start, not just for consumers, but also some banks have started to adopt that, is account aggregation. Account aggregation is a very powerful tool that is driven by machine learning, where seeing your different accounts in one app allows you to aggregate it, not you, but the provider of that, to aggregate the data and to actually run analytics in order to give better services in terms of better savings. Maybe do you need to switch your energy provider, etc. So Yolt, in a very innovative approach by ING to not just own the fintech, but to completely spin it out such that it would also work with competitors, has revolutionized account aggregation in the UK and in Europe. And there are examples of that in Australia and in Singapore. And what we see is that this is one of the first steps that are taken even by traditional players towards a data-driven approach. Because account aggregation means aggregation of data, and that is becoming a competitive advantage. Now, this is pretty basic. This is happening around the world, and in a sense, we are now surprised why we didn't have it before, but it's really with the rise of open banking and with advances in machine learning that this has become possible. The ones that are particularly driven by COVID are services that are within lending or within debt management in particular. So what we see, for example, an example that I studied extensively from Australia is Wiser, a lending platform that actually, through access, again, through your data using APIs to the extent that that's possible, they are able to not just give you an appropriate loan, but help you save in order to pay that off as soon as possible. So they look into your transactions and they offer you top-up opportunities whenever you spend money on coffee in order to make sure that you pay this off. And of course, this is good for the creditors, this is good for consumers, and it's an excellent use of machine learning in order to provide more tailored services that work for the individual. Another great one from the UK, which I have recently studied, is the case of Tully. Tully is a company, a fintech, that not only helps consumers, but they work with creditors, people that you owe money to, in order to make sure that you get your loan payments scheduled in such a way that you don't default. And when you don't default, even if creditors end up getting less money than they want to every month, the fact that you don't default is good for them. And it's also good for you because it doesn't ruin your financial history. And so therefore, this company actually monetized its business model by taking commission from creditors every time somebody signs up and actually starts to make even smaller payments to their creditors. So debt management and income smoothing have become particularly important with COVID, and that's really good in terms of the financial wellness of consumers around the world. And of course, we have to talk about AI-driven digital banks. Some examples from around here: Monzo, Starling Bank, Revolut, Atom. When I spent a year in Australia, I also studied the likes of Volt and Zinja, which have since then gone bust, which is interesting. And we have a paper looking into the reasons for that and why it's difficult, particularly to be in this particular sector. And what we see is that digital banks in general, they do have a lot of subscriptions. A lot of people sign up to them. However, because you don't have to leave your main bank, you actually end up putting relatively little money to play in this new bank. And so in a sense, it's almost like becoming your second home, but you actually don't spend a whole lot of resources on. And what we see is that these guys have a hard time breaking even because of the low average revenue per user that they get. And this causes them to not get to an asset base with which they can do loans, which is where they would like to be. The smarter ones among them, like Starling, as opposed to Monzo, for example, actually go after small to medium businesses very quickly in order to build that asset base and in order to get to loans as fast as possible, in order to make sure that they can get from red to black as quickly as possible. So trust is an issue. Customers don't know these guys, so they don't want to put their salaries, they don't want to put their savings into these accounts yet. And this is one of the reasons why these guys are growing slower than projected around the world. However, open banking isn't just an opportunity for data-driven fintechs. It is an opportunity for any data-driven business in order to offer more tailored services to consumers. And what we see is that is starting to open the floodgates to a lot of businesses that have been wanting to get into finance for a while. And in particular, in a recent study, what we've looked at is how different big tech platforms might take a different spot in the financial ecosystem. Take Amazon, for example. Amazon is different from the other platforms in that it has a very strong digital retail platform. The others don't have that. And so Amazon has entered finance, and particularly using their base of users and providers, suppliers and buyers on their platform in order to offer loans on both sides. You want to buy a TV? Now you can get an Amazon credit card and an Amazon account in order to pay in installments. You're a small business that wants to get started to sell things to sell jewelry on Amazon, then you can actually get a loan, business loan, in order to get started. Other players, for example, Facebook, lower trust by consumers. However, they have a huge advantage that they have one of the largest subscribers of the world to their social media platform. How can they use that? In the developed world, less so. However, in the developing world, in rural areas, there are millions of users of Facebook that don't have bank accounts. So Facebook is helping them leapfrog the bank account and go from using cash to doing peer-to-peer payments on the social media platform. So this is a very important trend that we see, which is unique to Facebook. Google has the largest set of data in the world, and it's natural then that Google is becoming a bank, a full-fledged bank in 2021, starting in the US. And the more traditional one of the players, Apple, that really prides itself and uses privacy as a competitive advantage, comparing itself to Facebook, for example, is offering more traditional services such as credit cards and maybe in the future bank accounts, but not projected so far. So the future of banking isn't just data-driven businesses in terms of data-driven startups, but much more so potentially data-driven big tech platforms coming into the place. These guys don't necessarily all want to become your bank, because that is an expensive thing to do, and it might not be the best way forward for them given their competitive advantage. But as you have seen in this picture, they have found different spots for themselves in the financial ecosystem in order to start to make profits and get into our lives in a way that we can call maybe the next step in embedded finance. All right, so here are some of the ways in which we see these guys move forward. And it's actually quite interesting to see that they are also getting into lending and mortgages. Mortgages are still out there, but lending is the first step. And it will be interesting to see how the next step happens in there. And overall, we see that this is a trend that is irreversible. It's going to be happening more and more. If you'd like to read the paper on the big tech platforms coming into finance, on the Oxford Future of Finance and Technology website, we have the PDF for free. So feel free to download it. It's authored by me and Ryan Jones. And finally, just to wrap up, our topic has been the pandemic, and I want to end with a few words on what we see in terms of regulated markets getting affected by COVID. So less regulated markets, such as restaurant, for example, switching from regular waiters to tablets and many other digital trends that are taking humans out of the loop in order to ensure that the pandemic is kept under control. We have seen these, there's no need to talk about them, but also in the regulated sectors, we see these differences. And in particular, what we are finding is that regulated industries are not being taken over by big tech platforms, and in particular, in general, data-driven businesses, but also big tech platforms, but they're being colonized by these platforms. And here is what I mean. They enter where you see this is from healthcare. This is from one of my recent studies. They enter typically as a healthcare provider. Being a healthcare IT provider in particular, having access to the data allows them to offer analytical tools in turn, especially prediction tools, which can be very valuable to healthcare providers, saving lives and saving lots of money through AI diagnostics, right? And that data that they get, they can then use in other parts of the system, which you can see on the left and on the right. They can use that data to fund new biotech and in general health ventures. They can actually manufacture smart devices, and they can work with universities and hospitals in order to give them the data for medical research, which they can then use in turn for new companies that they fund, right? So they're attacking the healthcare ecosystem from many places after having entered as an IT provider in order to make sure that they have access to the data. And in a sense, it's for the main healthcare providers, such as hospitals, doctors, healthcare conglomerates that you see in the middle of it, this is a good situation because they get to save money and they get to save lives and treat patients better. But at the same time, what they're doing is they're letting these platforms really dominate the rest of the industry in other parts of the value chain. Okay, so this is in a nutshell what I wanted to talk about today. Basically, a little bit of fintech, a little bit of kind of general information about how the pandemic is affecting regulated industries, with a particular emphasis on data-driven businesses. And with that, I thank you for listening, and I think that we're gonna take some questions now.
Thank you, Professor Pinar. We have one question, I think two questions in the Q&A box. The first one is, banking without a bank, is that to provide additional financial services to the people? Is that safe? What are the risks? So that's one question. The other question is, can you repeat the name of the paper you've mentioned, Professor Oskan?
Mm-hmm. Yeah, sounds good. All right. So banking without a bank. So what we, in a sense, one of the things that I'm sure that many of you have heard about as a switch from one world to the other is going from our bank as a platform where we get many services to a platform which becomes our bank. What we see is that what we used to consume as financial services within a bank are being unbundled. And some of these services are being offered as a loan service because they work really well in a different area of our life, which is the concept of embedded finance, embedded banking. And so as part of that, what we see is that people who don't have bank accounts, they have basic needs such as having to pay someone, having to receive money, getting a loan, right? Getting paid. How can they do that? And in these areas, especially peer-to-peer platforms, and especially platforms that have become dominant in those parts of the world, are starting to serve these customers. And we'll see this much more as a trend. And in a sense, it is a trend that is similar to how mobile banking ended up becoming very quickly prominent in Kenya, for example, where most of the population doesn't have a bank account. It became the main way to pay and to receive payments because Safaricom was able to build that network without the collaboration of banks, because most people didn't have a bank account at that point. So it's in a sense a leapfrog from going from cash, as I said, and then skipping the bank step in between. So you never open a bank account, but you actually start to load your money into a platform like social media platform for payments, etc. And then soon enough, that social media platform will have access to your financial data. And with that will come opportunities for loans and international money transfers, etc. So this is what we can say. The name of the paper, I think you mean the paper where we talk about the big tech platforms. That is called Jones and Oskan, and it is, and I'm writing this right now, Oxford Future of Finance and Technology Initiative. That where we published it. So it is a free paper to download, and if you Google it, I'm sure you'll find it. I am happy to share the link afterwards. All right.
There is another question from Islam. Do you want to ask the question directly to Pinar? Mafijul Islam?
You have to do that because the person...
I'll read it.
Yeah.
So the question is, the digitalization of banking services is really in demand at present. So, but his question is, there's also the related issue like protection from cybercrime, and then the volatility and inconsistency in internet speed, which also affects the quality of service. So what measures can we do to reduce some of these concerns?
Yeah, so a few different answers here. The first one is that, first of all, the use of APIs is going to make a lot of services and a lot of data exchange securer compared to the older technologies like screen scraping. So that is to the extent that open banking and open finance are implemented around the world and APIs become standard as they should, this is going to reduce the risk to a certain extent. And we also have seen that quantum computing can, on the one hand, in the hands of hackers, they can be a nuclear weapon, but at the same time, in the hands of banks and financial providers, quantum computing can really help secure systems faster, which is wonderful to see. And we have a project with the SWIFT Institute to look into that together. Internet speed is interesting, right? Internet speed, GPS, can you make your payments? Can you track where your money goes, etc.? And that kind of stuff. It's interesting in the sense that traditional players may not have an incentive to invest into these infrastructural problems. However, the resourceful newcomers into the financial industry will do so. So just like Uber invested into the safety of roads and GPS in Egypt in order to make sure that they could run their services, we will see more and more big tech and otherwise large established players investing into infrastructure around the world, especially in rural areas, in order to make sure that consumers around there have access to their services. They have the money to do it and they gain from doing this. And in turn, governments are, of course, favorable to these disruptors. And so it ends up being a win-win situation. You can also say this increases the monopoly of big tech platforms, which is absolutely true. But in my opinion, they will be the ones who invest into infrastructure around the world in order to make sure that internet services, and in particular within that financial services, will be available to everyone around the world.
Thank you very much. Let me see if there's some other, I think there's no more questions from the chat.
There's one more that I see in the open questions, which is, what do you think about the necessity of regulation of new banks at the very top?
Oh, yeah.
Yeah, if you think it is necessary to regulate, how do you think the regulator should regulate them? So we looked into this as part of our open banking research, especially in the UK. And one of the things that we see is that regulators have decades of history of regulating large institutions, right? And so they know how to establish the security standards, and they know how to check them. But these institutions are really resource rich. These are rich institutions that can invest a lot into conformance and into security. Now, when regulators come to regulate new players, there's a bit of a trouble, because regulators, even the regulations are so cumbersome that they take millions of dollars or pounds in order for new players to conform to. But in addition, regulators actually don't understand technologies that make these guys asset light. So can you use cloud computing? Some regulators around the world say, actually no, because we haven't tested that. And we prefer if you don't do that. Don't put customers' data on the cloud. And so when we see that regulators are not technically capable enough to accept new technologies in order for the entire market to leapfrog to these new technologies, then we come to a point where there's a bit of a roadblock, because even if you want to adopt these technologies, can you get the license? Can you actually get regulatory approval in order to operate in the market? We see this around the world, and in particular, my own data from Australia and UK show this.
Thank you very much.
I would have a question. So the shift to fintech by customers during the pandemic, we've seen this certainly in the UK and other parts of the world as well. But is there any insight into the response of the traditional banking sector to this? So are they becoming essentially more fintech style in their business models as well as a response to that, to compete?
That is a general trend. I have to say that the pandemic has not necessarily accelerated the adoption of new technologies and collaborations with fintech for established banks. In a sense, what I see instead is that banks have had other things to worry about during the pandemic. However, the pandemic has, as you say, very much accelerated the adoption of fintech services in particular areas. For example, if you have been furloughed, if you need to get paid in some way, and if you need to report that you lost your job, etc. Fintechs have done those services for customers so much faster than traditional financial institutions that there has been a larger adoption of these digital services by consumers. However, in particular areas that have been affected by the pandemic, not across the board. And unfortunately, established players, fintech is very much on their mind. They are working on collaborations, but not necessarily faster because of the pandemic.
Pinar, there's another question on general measures to cope with rising cybercrime, fraud, and risks emerging to digital financial services?
Yeah, I think in general, collaborations between large institutions and innovative new entrants like fintech is the best way to move forward. And these are happening, but not to a great extent. However, this is a good way because fintech is by nature innovative. It's a disruptor, but it doesn't necessarily have the experience to manage risks, especially cyber risk. However, on the other hand, we see these large institutions where their definition, their identity is security, right? And so a collaboration between them is actually a great way, a win-win situation where the fintech gets to be innovative, but gets to learn from the larger institution in terms of cybersecurity. Unfortunately, culturally, it's not easy for these guys to work together, and they really are trying. But to the extent that this becomes manageable, to the extent that the bank is able to leave its traditional culture and start to work with fintechs, it's going to be good for both parties.
And let me jump in. I have been observing the development for many years, and I really don't think that technology is an issue, because the technology now we're talking about in fintech space are very much commoditized technology already. Because of the one you're talking about, like a payment and all this, I mean, they're all very standard. You can literally just get some solution provider, give you something modified. And I think the real issue is something to do with organizational inertia. You know, we have, you know, the economist, the great economist called Joseph Schumpeter, years ago, many decades ago, talking about creative destruction, right? It's not really technology per se, it's adoption of technology due to organizational resistance. I've seen too many of those. So we're gonna see some banks or in other sectors as well die as a result of it. I mean, just think about a digital photography and kill Kodak, right? It's even the inventor of a digital photography. And so I think it's less of a technology, actually. It's a organizational inertia, which many banks, I think, is going to have a hard time of overcoming it. And they're going to be in trouble. Those one can adopt. I see, for instance, Singapore, in the DBS, and very quickly reacted to like a payment system. And now you can actually wire money overseas completely free. And so PayPal being cut out of it, right? Yeah, for instance, I will use a PayPal because of the lower wiring cost. And now all of a sudden, DBS is cheaper. So, you know, in other words, there is no technological advantage as far as I can see. It's all commoditized. It's an organization's ability to adopt it. I just, you know, added my own observation to this. And I'm not.
Absolutely. No, in fact, I think you're very right. And creative destruction is something that we use as a concept very frequently in our research papers. And that is the reason why collaborations are key, because collaborations are ways for traditional banks to not just work in order to offer things to their customers, but also to start to change their culture. Because things like the not invented here syndrome, or the fact that there's an aversion to using data just in case something goes wrong. Even, you know, as you probably very well know, some banks treat data as biohazardous waste. They want to contain it rather than open that box and use it, right? And so these these different mindsets that have made them survive in a world where security was key and innovation wasn't, are now becoming obsolete. And how are they going to learn if they don't have exposure? That's why collaborations are key.
I just want to offer an opinion in here, and very quickly. I sit on a board of directors of a bank in an emerging market.
Mm-hmm.
I was the chairman of the risk management committee. And when we went into digital banking, what we found was the mistakes that were made. Some of the things that went wrong in digital banking were the same problems that occur when we were not in digital banking. It was just lapses of control. It's not about technology, it's human beings. That is lapses of controls and procedures. So frankly speaking, from my point of view, we are overrating the risk of cybersecurity. There is, of course, there's risk. I'm not saying there's nothing, but I'm saying is that what we should do is that we use the same level and same level of integrity in our risk management for normal banking as in digital banking and fintech. It will be okay.
Yeah,
thank you.
Absolutely. And in fact, one of the fascinating stories that we were told as we were doing the open banking study in the UK was that cybersecurity was being used almost as a weapon to scare off customers to try new services. Banks were actually sending letters saying, we have seen that you use screen scraping to give access to a third party to your account. We want to emphasize that if something goes wrong, you are in no way covered. You should never do that otherwise, and actually threats in that letter. And this all, I mean, as Chuan also said, this all comes from a mentality of wanting to keep the customer base without really changing anything, wanting to stay in the old world. And I think that that's why cybersecurity comes up so much, especially when you talk to large banks. It's not necessarily that it's a huge problem, but it is a way to not adapt potentially.
So we have 3 minutes more. Any last, if there's any last burning question, otherwise we can, I think, John, we can close this session.
Yes, thanks, James. Thank you very much to all the speakers. Despite having a 10-minute faster session earlier, we finished exactly on time. So thank you for a very fruitful set of discussions this afternoon in Tokyo. And we will be back again tomorrow, 4 o'clock Tokyo time. So thank you very much. And that's all for this evening.